We're just sort of back to the narrative, really, of the last 12 months.
There's so much complacency in the market.
This can really overshoot to the upside.
It doesn't reduce market volatility, it actually increases it.
Volatility is higher. We have to learn to live with it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning, live from New York. This is Bloomberg Surveillance. Traders curbing their enthusiasm about the ceasefire agreement in the Middle East. Futures dipping and oil rising, with ships still struggling to get through the Strait of Hormuz. Employment data, inflation data, all coming up as investors examine the conflict's economic consequences. The bottom line, another day of being glued to the headlines. Annmarie, you're back in the seat, which is a wonderful thing. I mean, it feels like we're just sort of looking for signals and trading off headlines.
Well, it's because the rhetoric is not matching actually the facts on the ground. So the market has been squarely focused on the opening, or at least the safe passage, because the Iranians are absolutely controlling the Strait of Hormuz. And even though the White House said yesterday a number of times as the press secretary is briefing the press, they've seen an uptick, the facts are they haven't. Our data says about maybe 4 vessels got through. Kepler to the New York Times says 0. And today, Sultan Al-Jaber, the head of ADNOC, says open the strait unconditionally, no strings attached. Let's be clear here, the Strait of Hormuz is not open.
As we play headline roulette, we try to focus on exactly what could potentially have longer-term consequences. And we're very lucky to have for the full hour Dan Greenhaus of Solus Alternative Asset Management, who hopefully can do that for us. I mean, do you have a sense of what we could do with this other than just chase squirrels?
No, I mean, the last couple times I've been on, I said for most investors, the best thing to do right now is nothing. It's not too dissimilar to the tariff story, but there's meaningful downside risks, especially with an equity index that's barely off the highs. But to Annmarie, like, the headlines are coming so fast and furious here, I don't think most people know what to do with them.
At this point, are we seeing any long-term conclusions that maybe oil prices are higher, that there's a more of a risk premium being baked into markets, or
sure.
is it just otherwise pretty much inconclusive with the
Yeah, no, I think most people would agree oil's not going back to $60 anytime soon. There's that. Exactly what happens with the tolls. I mean, there's downside risks here, but other than oil meaningfully being higher than it was, I'm not sure you can reach any conclusions as of yet.
And RBC put out a note today saying, above all, we think the mechanics of reopening the strait will be exceedingly messy. If that holds true, then you're going to be looking at higher for longer, and then at some point to start to bleed through the rest of the economy in a more sustainable way.
Yeah, that was a fantastic note from Halima Croft. I recommend people look at it. Right now in markets, what you see is a bit of a reversal from what we saw yesterday. A bit of a risk-off tone pretty much across the board, although not necessarily retracing all of the gains. S&P futures down 0.3%, NASDAQ futures lower by 0.2%. You could see Brent rising once again after yesterday plunging the most since 2020, up 3.3% to $97.88. And 10-year yields just a little bit lower. Yesterday was a strange day for yields, considering the fact that on one hand, it was risk on, a feeling of maybe disinflation, but on the other hand, a pretty weak auction and some questions about long-term inflation. Coming up this hour, Keith Lerner of Truist, with stocks on track to snap a 6-day winning streak. OECD chief economist Stefano Scarpetta, as the Iran war weighs on the global economy, and Kit Juckes of SocGen on the risk of a policy mistake by the Federal Reserve. We begin this hour with our top story, a fragile ceasefire in the Middle East. Bloomberg's Jumana Persecci joins us now from Dubai. Jumana, you talked yesterday about how there still were strikes ongoing that were being intercepted by Gulf nations. What's the latest on the ground today?
Yeah, the latest is things are actually a little quieter today, Lisa. And I will say it appears as though the ceasefire is actually holding. As we said yesterday, we were reporting throughout the day, it got a little dicey. There were lots of incoming projectiles still being fired towards the UAE, Saudi Arabia, intercepted drone even above that east-west pipeline, that crucial pipeline in Saudi Arabia as well. But today, things have quietened down. But what I will say is the main front that has opened up is the Lebanon-Hezbollah front. And there appears to be a disconnect here between what Iran think was included in the ceasefire deal versus what the White House are also alleging on their side, and that Lebanon was never going to be part of this regional ceasefire. And what we saw yesterday was a series of very heavy airstrikes conducted by the IDF. They say they hit over 100 different Hezbollah sites in the space of 10 minutes, but it caused a lot of damage to buildings. The death count is more than 250 as we speak right now. And it has actually provoked an international community response. Many European leaders, including the likes of President Macron, saying that Lebanon needs to be part of the broader regional ceasefire arrangement. So as we head towards this weekend, it looks as though those in-person negotiations are going to happen in Islamabad. We know that the U.S. are sending their delegation, still unsure who from the Iranian side will be there. But number one of the main topics of discussion is what happens with the Lebanon front, and of course, the matter of the Strait. You look at the traffic through the Strait of Hormuz over the last 24 hours, there hasn't been a notable pickup. And effectively, Iran are still monitoring who goes in. They're still charging a fee, an unacceptable outcome for Gulf nations, as Annmarie was just saying. The CEO of ADNOC once again saying that they cannot hold this much grip over such a key waterway around the world. So there's still going to be a lot of pushback, I think, and a lot of a push diplomatically to ensure that the Strait does fully reopen unconditionally at the talks this weekend, alongside all of the other topics, including the nuclear stockpile, the enriched uranium stockpile, alongside Iran's funding of proxies in the region and their ballistic weapons. So there's still a lot that needs to be bridged in the coming days.
Germano Bersace, thank you so much, as always, for that report coming to us from Dubai. Here's the view on Wall Street this morning. Keith Lerner of Truist writing, the market remains highly headline-driven, which helps explain the sharp reaction to recent news. The bull market still deserves the benefit of the doubt. Keith joins us now. For more, Keith, great to see you.
Thank
you for coming in.
Yeah, thank you.
So why does it still need to get the benefit of the doubt, given the fact that there still are a lot of risks on the table?
Yeah, well, there's always risk in the market. I would just say, and there's still risk. I mean, obviously, this is going to be a messy situation. But we also have to remember this bull market has been battle tested. We think about since COVID, we've gone through a series of shocks, right? We've gone through the COVID shock, the fastest rate hikes since the 80s, the highest inflation since the 70s, the terrorist shock last year. And there was, in some cases, even more meaningful downside, obviously, than where we are today. But eventually, markets rebounded and earnings rebounded as well. So, again, I think this is going to be a messy period. We are on the one-year anniversary of that 9% move last year. But if you look at what happened after the kind of the pause in tariffs last year, as maybe a little bit of a roadmap, even though we know there's a lot of things different. I mean, the next day you were down 3.5%, and it was a very choppy period. So that's that's our kind of baseline today. That's going to be a choppy period. But we still think ultimately what happens with AI and other things outside Iran also matter.
But isn't this different than last year? Because last year, Trump was in full control. This year, he's dealing with a party that's very unknown. It's still the same regime, just some different players. He can't control for that.
Yeah, certainly. And again, I think when you talk about analogies to past, or analogs, I should say, to past periods, like there's a lot of differences from last year. But at least, I think, again, going back to one, investors have been conditioned a bit that not to overreact in some ways to each event. And again, I go back to the U.S. economy's ability to adapt. And an interesting stat that I've been sharing with some of our clients, since the global financial crisis, which is about 17 years ago, or 200 months, we probably talk about recession 85% of the time, but we've been in recession 2 months, which is 1% of the time. So again, it doesn't mean that maybe I'm jinxing it by even bringing that up. But again, I mean, we all know that the energy intensity of the economy is somewhat different than it was over the last couple of decades. And I think more importantly, as we start to go into earnings season, really is what's happening with AI, again, which drives about 45 or 50% of the S&P 500.
Staying on the geopolitics, though, Goldman out this morning was saying if Brent averages $100 a barrel, basically it will stay that way for the next year if the Strait is closed for another month. And at the moment, the Strait is closed. What's going to be the impact on earnings if that is the base case? Yeah, well, I think, in some ways it will be disparate, right? I mean, going back to the AI comment, I don't think this is going to really impact with the AI spending, which is the main driver, the strongest earning trends within the market still. I mean, we're seeing earnings for the energy sector obviously revised strongly up, but it's going to be more of a negative for the consumer. It's going to be more of a negative for staples. It was notable that yesterday Delta came out still saying we have somewhat of robust demand. And the other part I would say, going back to earnings, that is the North Star of this bull market. We are still seeing forward earning estimates, which will change with a lag, making new highs. And we're seeing that broaden out, at least before this. I do suspect, though, that we'll likely see some of these trends flatten out somewhat. But again, I think it's going to be hopefully nice to get into the earnings season so we have something else to talk about somewhat
each morning?
I can embrace that and endorse
Okay,
that wholeheartedly,
appreciate that. Thank you.
especially because yesterday, as you said, we got Delta earnings, which was really telling. People are hoping that the economic data this week will offer some reprieve from just chasing the different headlines and exactly whether it's ceasefire on or ceasefire off or what it actually means. We're going to be getting core PCE later today. We're going to get jobless claims tomorrow. We get PCI data. All of this coming, Dan, as people try to figure out what the economic ramifications from some of the conflict really looks like. I mean, do you get a sense of what we'll learn this week, particularly tomorrow, with respect to the inflationary component stemming from this crisis?
I don't think we're going to learn very much. I think we know that in the short term there's going to be a big spike in the energy component of various inflation measures. But to Anne-Marie's point, the issue here is persistence. And so, again, I've said this before, but it bears repeating. We call them oil price spikes, not oil price plateaus. And if oil prices were to remain high, if gas prices were to follow and get up to $4.25 or even $5, and which is a distinct possibility if this goes south, then you start to worry a little bit more about the strength of consumer spending. But to Keith's point, I don't think it's particularly recessionary. You'd really have to stress the consumer in a healthy labor market with real wage growth to start talking about a recession. The bigger issue is with an economy growing, call it 2.5%, how many tenths do you start to shave off? Again, I don't think it's bear market inducing. I don't think it's recession inducing, but it's enough to start taking down noticeably your estimates.
I just wonder, though, is this more inflationary than it is, for example, a hit to growth that could potentially be good for stocks in the long run?
There's a lot of moving parts, but I would say also, Dan, you talked about not overreacting and not doing much. I do think on the margin, there are some things on the margin we did. Like, for instance, yesterday, we saw energy stocks at one point down about 4 or 5%. We actually upgraded energy yesterday, not because we think it's necessarily going right back to where it was, but because the range of outcomes are so wide. We're overweight industrials, we're overweight tech. If this situation escalates, then on the margin, we'll go back to energy being an outperformer as well. We also recently just extended our duration for the first time in a while. I know, we are near, 1-year highs, or we were on yields, and we've actually dipped our toes back into high yield for the first time, as well as credit spreads have widened and yields are above 7%. Again, not going all in. But, if you wait for all certainty, the market has moved. To Dan's point, the S&P, if I gave you all the headlines, we should probably be down a lot more. So I'm not saying that's a great opportunity yet. But we've been telling, last week towards the end of last week, we were saying at least on a short term, we were seeing some signs of an oversold condition for the market. Not an extreme relative to what we've seen in the past, but enough to say, let's start dipping our toe back in.
Although I will say, the headlines are near highs. But as investors, we're picking individual stocks, individual credits. Yeah. When I talk to people, they are way more shell-shocked than the headline index would suggest, because a lot of stocks are down 20, 30%. A lot of widely held stocks. Maybe we don't discuss them on TV every day, but among investors, there's a lot more pain than obviously the headlines would suggest.
Which is the reason why a lot of people are looking at how much positioning has changed, even if maybe the headline index hasn't come down that much. Keith Lerner of Truist, thank you so much for being with us this morning. Really appreciate seeing you. Dan, we're not letting you go just yet. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira and Yahira.
Good morning, Lisa. The White House saying Vice President J.D. Vance will lead direct talks with Iran and Pakistan. Vance will be joined by Special Envoy Steve Witkoff and Jared Kushner. The first round of talks is set for Saturday morning local time. Iranian officials say Israel's strikes on Lebanon violate terms of the ceasefire agreement. Israel launched its largest assault on Lebanon yesterday since the start of the war. The country's health ministry saying at least 182 people were killed and hundreds were wounded. And 2 Chinese oil tankers are waiting near the entrance to the Strait of Hormuz, hoping to be the first non-Iranian ships to make it through since a ceasefire was announced. Despite the agreement, traffic through the chokehold has been little changed. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira and Annmarie. It's really interesting that China is trying to test this first, that there are 2 of them lined up waiting to get through.
You can't pick a friendlier country for Iran. It was the entire reason why Iran had any inflows of money coming in for years, because they buy the lion's share of their crude, and they are even having trouble transiting through the Strait.
Which just highlights the problems right now with really depending on the ceasefire. Up next, a fragile truce.
I think the Iranians thought that the ceasefire included Lebanon, and it just didn't. If Iran wants to let this negotiation fall apart in a conflict where they were getting hammered over Lebanon, which has nothing to do with them, that's ultimately their choice.
OECD chief economist Stefano Scarpetta joins us next as we try to parse through the economic consequences. This is Bloomberg Surveillance. Good morning. Stocks giving back some of the optimism that we saw yesterday after some questions about just how consistent the ceasefire can actually be, considering the fact that ships really are not going through the Strait of Hormuz just yet, and a lot of pretty animated rhetoric from both sides. Right now, you're seeing S&P futures lower 0.4%, NASDAQ futures down about 0.33%, crude getting back up in action, up almost 4%, $98.43, and 10-year yield just a touch lower. Really an interesting story of what the haven bids have been amid a potential inflationary push. Under surveillance this morning, a fragile truce.
I think the Iranians thought that the ceasefire included Lebanon, and it just didn't. What we said is that the ceasefire would be focused on Iran, and the ceasefire would be focused on America's allies. If Iran wants to let this negotiation fall apart in a conflict where they were getting hammered over Lebanon, which has nothing to do with them and which the United States never once said was part of the ceasefire, that's ultimately their choice.
Here's the latest. Crude climbing as Tehran says some terms of the ceasefire have been violated. The energy shock rippling through the global economy. Joining us now, I'm so pleased to say, is OECD chief economist Stefano Scarpetta. Stefano, thank you so much for making some time. How much are you looking at a dampening effect on the global economy as a result of what's going on in the Middle East?
Well, of course, there is a lot of uncertainty. We just published our interim economic outlook on the 26th of November. And basically, if on the 28th of February, before the war in Iran, we would have actually raised upward the projection for global GDP growth for 26 by 0.3 percentage point. All of that was shaved off because of the impact of the war and the crisis in the Middle East and the increase, of course, in energy prices. Now, the recent announcement of the ceasefire, if it is implemented, if this means, of course, reopening the Strait of Hormuz, and we have seen already in the impact on the price of oil, would have sort of an effect on the economy, and we see already a reduction in the price of oil. But of course, there are a lot of ifs here because these have to be maintained, the ceasefire, and we have to see exactly vessels getting through the Strait of Hormuz. So, unfortunately, we had to revise basically our projection by all the increase that would have happened if it was not because of the war.
How much are Europe and Asian nations disproportionately affected by the fact that oil prices are likely to remain significantly higher, even if there is some sort of conclusion, at least in the in the near term, to this conflict?
No, indeed. Of course, Asia in general and Europe are more affected by the hike in price of oil and gas, in particular the Asian countries. But I think even within the Asia region, there are significant differences because two countries that depend heavily on oil getting through the Strait of Hormuz, like Korea and Japan, they have large reserves, while other countries in the region, Indonesia, Thailand, have much smaller reserves, so they're more exposed to the hike in price than the other two countries. Europe, of course, is also dependent on gas coming from the Strait of Hormuz, so is, of course, more exposed. What matters really is the duration of this increase in oil prices and gas prices, and, of course, whether or not there have been damage to the infrastructure in the region, in Iran and other neighboring countries, because, of course, repairing the damages may take long, and this may actually have an impact on the profile of oil and gas prices going forward.
When it comes to duration, when do you know you can no longer just look through this and actually there's going to be structural changes and permanent shifts?
Well, that's a good question. It depends, again, on for how long the price will stay high. We have seen short-term responses in many countries of the OECD, including support to consumers and to firms to face this hike in energy price. We have seen that in Europe, but basically in most of the OECD countries, the early measure that have been introduced has been a way to basically reduce the increase in price at the gas station and for the companies. But of course, these are very expensive, so they cannot be prolonged for too long. And our recommendation is to try to move as quickly as possible to more targeted measure that actually provides support to consumers most affected by the increase in energy prices and actually to the firms that depend more by energy. So this is, I think, is our recommendation. Then, of course, there might be some rationing. We have learned through the COVID crisis that there are some telework actually may reduce the consumption of energy. And I think these are also implemented by a number of countries indeed.
Well, do member countries have the fiscal capacity to fight this?
That's a very good question because, of course, the fiscal capacity is limited, and that's one more reason why we are recommended to move into targeted measure and actually temporary measures because, of course, what happened in the 22 energy crisis was some of the price support measures were kept for too long, and this led, of course, to significant public spending in this area. So there is a need to targeting, and there is also a need to already introduce sunset clauses whereby if the price go down, then this measure will be removed quickly.
Stefano Scarpetta, OECD chief economist, thank you so much for being with us this morning. Dan Greenhaus of Solus is here with us this morning. How much are you looking at this and saying Europe really cannot be the trade that people go to for diversification because of some of the risks that you see from both higher commodity prices and, frankly, geopolitical alliances that are shifting?
Yeah, I think that's probably right. I think it's too simple to say Europe is trading cheap to the U.S. in a variety of metrics, or I think after so many years of outperformance by the part of U.S. risk assets, there was a sense that now it's the world's turn, if you will. And that looked like it might be the case for a little while. But I always come back to the reality that the U.S. is still where the world's growth is, both from macroeconomically and from a corporate standpoint. And I still see tons of value in the long term from U.S. risk assets on a comparative basis.
How much has big tech in the U.S. become the haven trade? I mean, honestly, this is, to me, is sort of the irony, once again, of 2026 and how much it's reminded us of 2025. Everyone came in broadening out. The economy is going to broaden. You can invest in the rest of the world. And then, bam, after Liberation Day, not so much. Is it the same thing now?
Yeah, well, listen, the Mag 7 in large tech has been a haven trade for quite some time. They just have much better growth profiles, cash flow profiles, et cetera, et cetera. And so to the extent that anyone was worried about their valuation premiums, they kept telling you quarter after quarter that they earned and demanded that level of a valuation premium. And to a large degree, that's still true. I think there's probably some exhaustion here in the sense that, well, let's broaden out. It doesn't have to be Google. It could be SanDisk, et cetera, et cetera. But yeah, I think they're absolutely safe haven trades. But again, they're doing so well fundamentally, it's really hard to argue with that.
Keith was putting a lot of emphasis as well on the AI trade, but these are energy-heavy trades, right? These are data centers. Yep. These are companies that are going to use a lot of energy. At some point, does that cost matter, or they're too big and too great where a few extra dollars on diesel and gas doesn't really matter?
Well, no, it certainly matters. And where it really matters, we don't spend enough time talking about it, is on the political front. I mean, you've seen several states, I think Maine just did something where they prevented a data center from being built. It's particularly in the Virginia area where you see the most data center construction. There's a lot of concern about energy prices. Everybody everywhere is worried about water and electricity. We've already seen U.S. electricity prices go up. So this is a growing and not likely to end soon story.
Well, the president actually told energy companies they need to basically subsidize consumers.
Sure. We'll see how this unfolds. I think you're going to end up at some point with legislation. I mean, the president says a lot of things that
he did a whole event with Meta.
Sure. But the fact that it rises to the presidential level that he would have an event speaks to the political sensitivity around the rise in electricity prices, again, particularly in the Virginia area. So I don't think that's, but from an investment standpoint, I don't think that's particularly prohibitive right now. What's going on with Google fundamentally, what's going on with Meta fundamentally in terms of driving traffic and the ability to stave off AI from search, in Google's case, obviously, is far more determinant in the short term than the electricity or power costs more generally.
And it's frankly an inelastic CapEx, right?
That's right.
So it's something that is price independent at a time costs are going up, but that's okay. Ultimately, as we've seen from a lot of the bond offerings too that have come out and frankly have been oversubscribed to a lot of the data centers. Right now we're waiting for what we get at 8:30 a.m. Eastern, which is core PCE, personal income and spending. We'll get a read into exactly how people are keying off what's going on now, but also how much momentum there was coming into this, as well as jobless claims, which frankly have fallen off a cliff. It seems like that doesn't seem to matter anymore. Heading into tomorrow, the PCI, the CPI data I mean, ultimately, we're going to see an inflationary impact. At what point, AMH, is it going to start to bleed through in terms of longer-term sentiment?
Especially when you look at the Fed minutes and you see that there is a concern about inflation. They do see risk to their dual mandate.
Yeah, well, coming up, we're going to talk about the keynote of that inflation, oil prices. Stephen Schork of the Schork Group, with crude trading back near triple digits. Plus, Yahira Anand with your morning movers. Datadog rising as the software firm gets a fresh upgrade on Wall Street. This is Bloomberg Surveillance. Good morning. Ceasefire. What ceasefire? That's what the market seems to be implying this morning as it assesses whether or not you can get some sort of more permanent resolution between Iran and the U.S. But you can see in markets a little bit of a taking back of yesterday's enthusiasm, about 0.3% decline on S&P futures, less on the NASDAQ 100. Futures are lower there, only by 0.2% as people look to that as the haven trade. Russell 2000 down 0.6%, with bonds very much in focus. Yesterday, a really tumultuous day. I'd love your thoughts on this, Dan. I mean, ultimately, right now, you are seeing a bid back into bonds. But yesterday, what happened with the 10-year auction, with what happened with rates actually giving back some of the gains and then some, even with the optimism that clearly is fading this morning, but at the time was still intact?
I think in the short term here, everyone is trying to figure out what's going on with the ceasefire that isn't a ceasefire, with ships going through the Strait but aren't going through the Strait. Iran is telling ships they need to ask for permission. Listen, at 428 on the 10-year, I know there's a lot of concern that it's up from 4, but I could also say it's down from 5.
All right, well, there you go. And this is the reason why people are looking at the length of how long this conflict will go on, what the contours of this conflict are, and the Halima Croft point, the permanent risk premium that needs to get baked in. When you take a look at crude prices right now, the June contract for both WTI and Brent, both higher by more than 3%, still below $100 a barrel in AMH. It seems like people are assessing this as a positive sign, even though there are so many questions and so much hair around the ceasefire.
Absolutely. So I think going into the weekend, there's going to be a lot of risk. People maybe just want to stay on the sidelines, because what actually happens in Islamabad, given how far apart the Iranian regime is to what the President of the United States wants to see.
Dan, is this tradable in any way, shape, or form?
Yeah, I mean, for fun, but I don't think anyone thinks. My guess would be most people don't think they can convincingly make money on, to the point about the ceasefire not being a ceasefire. No one agrees on anything, and there isn't even a ceasefire. The second the headlines hit, there were missiles being flown into various countries. The East-West pipeline was bombed, and this was right after the ceasefire. So no, I don't think you can necessarily trade this in any convincing way.
So bullish poly market and bearish the rest of the market. 3 hours away from the cash open. Here's your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Applied Digital. Those shares falling 3.6% in the pre-market, even after the company gave a strong quarter. Revenue more than doubling, but margins coming in well below estimates, and the company plans to spend even more to build out AI data centers. So it's a familiar theme playing out. Strong AI demand, but the cost to keep up is weighing on profits and hitting the stock this morning. Meanwhile, we are seeing shares of Marvell rising nearly 2% in the pre-market after a fresh upgrade by analysts over at Barclays to overweight, pointing to surging demand for optical chips tied to AI infrastructure. Barclays saying that part of the business could grow close to 90%, even amid competition from the likes of Broadcom, and that's extending a rally that's already seen this stock jump 35% year to date. And we end on some more sell side action with Datadog up 3% in the pre-market after analysts over at Guggenheim rated it a buy. Analysts see the cloud software company actually benefiting from AI-driven data growth. And this is notable because this was one of those stocks caught up in the SaaS apocalypse back in February. Lisa.
Thank you so much. Yahira answering a question I think AMH had about what Datadog was. A premier cloud-based monitoring security platform.
I just heard Datadog and I thought of Dogecoin.
Really?
Maybe Datadog uses Dogecoin.
I thought of a hot dog wrapped in a silicon case. Anyway, on our radar this morning, Israel launching its largest assault on Lebanon since the start of the war, targeting more than 100 Hezbollah's military sites. The attacks putting the U.S.-Iran ceasefire in jeopardy as Tehran threatens a heavy response. Vice President J.D. Vance heading to Pakistan, where he'll lead U.S. talks with Iran. Vance saying he hopes Tehran will negotiate in good faith. The first round of talks are scheduled for Saturday in Islamabad. Do we think that they're actually going to take place, AMH?
At this moment, the White House was pretty direct yesterday, naming names of who's going to go. Alongside him will be Steve Witkoff and Jared Kushner. But of course, to Dan's point, a lot of people don't believe this ceasefire is real. So potentially what happens in the next 48 hours, I think, will determine whether or not you see that meeting.
Yeah, it's some real mixed messaging coming from the Iranian side. Meanwhile, in the United States, Fed officials seeing two-sided risks from the Iran war. The minutes of last month's FOMC meeting show some officials are open to even a rate hike due to inflation concerns, while most worry a protracted war could hurt the labor market, warranting a rate cut. Dan, it seems like the market shrugged this off as just trying to job on the market into behaving when it comes to inflation expectations. Do you think a rate hike could squarely be on the table with an increasing number of officials a little bit worried that they haven't reached their 2% target in more than 5 years?
I don't think so. I don't think a rate hike is legitimately on the table, especially because I've come down in the former camp, which is if oil prices spike and stay up there for some period of time, and that starts to weigh on demand, et cetera, I think you could make a case that a rate cut is even more likely rather than a rate hike. But yes, I think the minutes are probably out there telling people, that's what the minutes are for. They get edited up until the day they get released, and they sort of want to convey a message. The Fed can do it through the minutes, and I think they succeeded in that way yesterday.
Does it really matter as much as it used to a lot of traders in the market, what the Fed minutes or even Fed rhetoric sounds like right now?
Listen, the Fed really matters most at the extremes, when they raise rates too high or they cut rates too low, quote unquote, in both cases. In the middle, you get a lot of people who come on air saying, does 25 basis points really matter? And I think we're probably in one of those worlds right now. There are a lot of people, I include myself, who thought rates were too high at 5.5, too high at 4.5. At 3.5, you have a much more balanced take on things. I still think they're probably 25 or 50 basis points too high, but there's a good debate either way.
Lisa, I think who it matters to is Kevin Warsh. It's like a warning shot. This is the group of individuals you're going to be dealing with when you finally go through a Senate confirmation and get a vote to actually lead the Federal Reserve.
I apologize. Also, some of this is positioning on the part of the Federal Reserve in front of the incoming Fed chair. Right. I should have mentioned that as well.
That's actually a really good point. We'll talk about that more coming up. Turning back to our top story, the U.S. and Iran gearing up for peace talks on the heels of a fragile ceasefire.
The president will only make a deal that serves in the best interests of the United States of America, and he as a negotiating team will focus on this effort over the next 2 weeks, so long as the Strait of Hormuz remains open with no limitations or delays.
Bloomberg's Tyler Kendall joins us now. Tyler, what's the latest?
Yeah, hey, Lisa, good morning. Well, President Trump posted on Truth Social overnight saying that the U.S. remains ready to resume military operations if Iran does not adhere to the ceasefire and until a full agreement is in place, putting the same emphasis, as you just heard the White House press secretary there, on the need to reopen the Strait of Hormuz. Because yesterday, Iranian state media had reported that Iran was going to continue to halt ships as Iran maintains that it needs to see fighting stop in Lebanon in order for the 2-week truce to take place. Now, this despite the U.S. saying that Israel's separate front against the Iranian-backed militant group Hezbollah was never part of any ceasefire deal, and President Trump is downplaying the potential that it could derail diplomatic efforts. Now, we did hear from the Vice President J.D. Vance yesterday, who is leading the U.S. side of negotiations, say that the U.S. has started to see signs that the strait is reopening, despite data analyzed by Bloomberg News showing that only 3 ships exited the region yesterday amid an 800-vessel backlog. And new this morning, Iran saying that it has established safe passage routes for entering and exiting the waterway in what appears to be a bid to avoid the potential presence of mines in primary traffic lanes. Now, Lisa, yesterday, President Trump met privately with the NATO Secretary General Mark Rutte, as a senior NATO official tells Bloomberg News that the U.S. made it very clear that they would like to see tangible plans presented within days on how European allies are going to help secure the waterway.
Tyler Kendall, thank you so much for the reporting. Oil, meanwhile, heading back toward triple digits. Stephen Schork of the Schork Group writing, the market isn't pricing in full normalization yet. Until crude is physically moving through Hormuz, oil prices stay structurally bid. Stephen joins us now. Stephen, thank you so much for being with us. How much are you gleaning in terms of whether the Strait of Hormuz is open, whether it's not open, and what a new normal could look like?
Yeah, absolutely. Thank you and good morning. So we're looking at the spread action, and actually with all of the headline numbers coming off significantly, some of the spreads being cut in half, the spreads that is for NYMEX WTI. When we still look at the market, West Texas oil delivered into Houston, bid against European oil, surged 20% yesterday. That is to say, dated Brent cargoes traded in the North Sea moved to a $19 to $20 premium to Gulf Coast crudes. So that is your clearest telltale that the market is highly skeptical that the ceasefire is real, it will take, and it will actually open up the Strait of Hormuz. So until we start to see some sort of convergence between global energy prices, dated Brent or Dubai, against the Gulf Coast crudes, the message is that this ceasefire is just headline only, and it's all about the barrels and the flow. And right now, we're not seeing either of those two.
Yet still, Brent is under $100 a barrel. And maybe yesterday, 4 vessels got through the Strait of Hormuz. Shouldn't actually prices be higher?
Yeah, and it's an excellent question. And to your point, they are higher, and it's all relative. So this point, Gulf Coast crude, delivered into Houston right now, is the cheapest barrel on earth right now. And those spread differentials at $19.20, if we look at the Dubai market, at the end of last week, it was $30 a barrel. So getting a few vessels through, when you start to hear the rhetoric that's still coming out of Iran, certainly doesn't sound like this ceasefire will take at this point. So, I mean, should they be higher? In a flat price, I mean, the market is the market. What we're looking at is the difference between locations. And right now, the location of oil where it is, that is to say in the Gulf Coast, where there is plenty of that oil, and where it needs to be in Asia, we're still looking at an extremely wide differential. So it's all about the differential between locations rather than just the flat outright price.
Are Asian customers looking for product elsewhere, like the United States?
They are our contacts in the Gulf Coast. The Asian buyers, particularly Japan, would be rather discerning on where they're buying the crude, their quality of the crude. At this point, and this has been the get-go for the past few weeks, Asia's coming in full blast, and they're discerning on quality, location, so terms, so forth. It was buy first, negotiate later. So we've already started to see that massive influx of Asian buyers into the Gulf Coast. European buyers were a little bit behind the curve. So what we're starting to see now is a balancing of the Brent market. And I want to be clear about this, not the futures market. The futures market on ICE is delivered in June. The dated Brent market is barrels, actually the physical market actually being traded today. And that diff is still, as we said, about $20 a barrel. So we saw a equalization of Asia, the Asian bid and the European bid coming into the Gulf Coast. But this is where the action is right now. So prior to the ceasefire headline, what you started to see is Gulf Coast crude, NYMEX WTI migrate, being pulled up to where the global price is. If we do get a ceasefire, again, what we saw with the spreads is there's still a lot of skepticism that we'll see any of this oil flow anytime in the near future. And hence why I said in the note to clients that regardless of whether the ceasefire takes place, we're in a new normal right now where the fundamentals are constantly shifting underneath our feet.
Stephen, I had several questions for you, and you just answered all of them in that one long answer. So I'll follow up with. So we've seen the intensity of demand out of Asia. Numerous reports are bearing out exactly what you just said. How long do you think it takes for that demand intensity to migrate from Asia to Europe and eventually the United States? Because to Anne-Marie's question about, and your answer about the differentials between U.S.-based oil and global oil benchmarks, how long till that stress starts putting upward pressure on the other metrics?
Well, I think right now, again, Dan, looking at those, actually the spread action going out for the next 3 months, we have an extreme war premium priced into the front end of the curve to the point where just because of this headline, those spreads, and I'm talking NYMEX WTI, were cut in half. So if we look out for the next 3 months, the market is telling us it's going to be any sort of 3 months before we start to see any sort of kind of normalization. So right now, we have to keep in mind we're coming out of the turnaround season, the maintenance season. So physical demand for oil from refineries is actually at its lowest point of the year because refineries are in their maintenance season. So they're processing less crude. They're buying fewer barrels. Now that we're getting to April and then next month, Memorial Day, the kickoff to the Northern Hemisphere holiday season, this is when we really have to be wary of. So the futures market is staying at least 3 months before we see normalization. Dan, to answer your question, we are within 2 months as the second component now in the thesis kicks in. That is to say, rising demand here, particularly in the United States, as we all. I'm in Pennsylvania, so we all head out to the Jersey Shore. New York, you're all going to drive out to the Hamptons. So when that demand starts to kick in, that's when we'll start to see some real action here.
Stephen Schork of the Schork Group, thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. President Trump lashing out at NATO after a meeting with the Secretary General, Mark Rutte. In a post on Truth Social, Trump writing, quote, NATO wasn't there when we needed them, and they won't be there if we need them again. Rutte saying he and Trump had a frank and open discussion. The U.S. is considering lifting sanctions on Venezuela's central bank to facilitate the flow of billions of dollars into the country's economy. Sources telling us here at Bloomberg the move would allow proceeds from oil sales to circulate more freely through Venezuela's financial system. And PIMCO is looking to sell portions of the $14 billion debt deal it's providing for Oracle. The tech firm will use the funds for a massive data center in Michigan. Sources telling us here at Bloomberg the financing is being led by Bank of America, with Blackstone contributing about $2 billion in equity. The companies declined to comment. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahaira. Up next, the case to wait.
I see the underlying fundamentals of the economy as really in a good place. The question is, what's going to happen with the war? It's really too early to make any statements about that because we don't know how long the conflict will last.
Kit Juckes of SocGen joins next. This is Bloomberg Surveillance. Good morning. The risk-on field from yesterday fading into just slightly risk-off as people question the state of the ceasefire. Right now, you can see that in markets with equity futures lower. You can see that bond yields actually going lower as well with a bid there. Dollar losing some clout. This is interesting because at one point this was the haven trade, and this morning, even as oil prices rise, you're not seeing that bid into the U.S. greenback. Under surveillance this morning, Fed meeting minutes for March show some officials are willing to keep rate hikes on the table if higher energy prices continue. Still, most are worried about a longer war and ultimately structural changes. This is what's getting a lot of people in markets interested. Kit Juckes of SocGen joining us right now from our London studio. Kit, I'd love to get your thoughts, not just on Fed positioning, but the broader debate that's going on right now about whether Iran is going to charge nations in yuan, Chinese renminbi, or Bitcoin to traverse the Strait at a time when people are wondering whether the dollar's dominance is being called into question. How much are you hearing about that, fielding questions about that?
I definitely have been, for a while in various forms. There's no doubt that more people would like to transact away from the dollar, partly because, there are constraints imposed in terms of, I work in a bank. If we do transactions with the wrong countries, we get into all sorts of trouble if we do it in dollars. So there's pressure, and the Iranians are clearly part of that. It reduces the dollar's share of global transactions, but from a huge percentage to a really, really big percentage. So dominance remains, but it's not quite as dominant as it was before. And that's probably, a good thing, because the US share of the global economy is going down as countries like China grow. And remember, once upon a time, sterling was the dominant currency. It definitely outlived its use, became a problem for the UK, and it was a good thing for everyone when the dollar replaced it. So I don't think there's a replacement. There isn't an alternative to the dollar, but there's no doubt more people would like to have more of their savings somewhere else, and they would like to do fewer of their transactions in dollars. That is nibbling away at the dollar's importance.
How much, Kit, do you see this in the lack of a haven trade that you've seen in the dollar? You have seen a knee-jerk bid into the dollar during times of extreme stress. Some people have argued it isn't as significant as it would have been in prior times of volatility. Do you agree with that? Do you think that limits some of the upside?
Okay, I certainly think that the dollar did less well. Euro dollar got to 114 in the height of this. I thought it might get to 110. So the dollar did less well in the rally of the kind of the heat of this war, and it's doing much better than you think it should at the point where some of where at least we've got sort of a ceasefire. So there's something in that. It's not just, though, that the dollar's preeminence is going. It's that this U.S. administration makes some investors nervous. They would like to find a way to keep interest rates low. They would like to continue to run large fiscal deficits. They would like to continue to have high unemployment, and they would like to have high employment, very low unemployment, and they would like to have their cake and eat all of it at this point. It's kind of everybody else is talking much more aggressively about perhaps needing to counter higher inflation with higher rates than U.S. officials are.
Well, when it comes to higher inflation, if we get another big spike in energy prices and this ceasefire does not hold, what do you do with the fact that you like the yen right now? Do you abandon a yen long? Because energy spike is not going to be good for Japan.
The yen long was more appealing yesterday than it is today after the events when we see the ceasefire kind of creak a little bit. And I think that is a problem. I'm still somewhat comforted by the fact that dollar yen, having made it to 160, is struggling to get through in sort of purchasing power parity terms or any other terms. It's the most beaten up of the major currencies. So I have no interest in shorting it. They're hugely dependent on foreign energy. So it'll do well when energy prices start coming down. I suspect the miserable answer is that if energy prices stay high for longer, dollar yen stays at 159 to 160 for even more time.
Hey, Kit, so we talk a lot about the move away from the dollar weakness, et cetera. But if we use for a lot of people, we'll use the DXY as the barometer. It's basically at its average level over the last 10 years. It's still 10, 20% higher than it was around the time of the mid-2010s of the taper tantrum. It's still 90% or 75% of global trade. According to the IMF, it's still 55, 60% of global reserves. It still is a reserve currency, and the main reason why is there's no alternative. So for the foreseeable future, it's still the dollar, no?
Yes, the dollar is still the world's dominant currency. It's slightly less dominant than it was, and I suspect it may continue to be slightly less, but that's just a good thing because the US is the world's dominant economy. It's just as a share of global GDP, it's a little bit lower, and there's been more politicization of the dollar. I think the valuation story is about really US monetary and fiscal policies more than about people losing faith in the dollar. In other words, if the Fed raised rates more than the ECB, more than the Bank of Japan in the face of an inflation shock, the dollar would go up.
And right now, people are expecting the opposite. Kit Juckes of SocGen, thank you so much for being with us. Really appreciate it. That really is kind of the key question. And Dan, look, I could tell you're pushing back, and I think a lot of people would agree with you. We've been crying wolf a long time on this idea of dollar dominance losing its clout.
I'm sorry to interrupt. I have in my phone a bet with Peter Bookvar from like 10 years ago that the Chinese yuan would be a comparable reserve currency to the US dollar in like 15 years' time. I can't find it in my phone right now, but that bet exists. Meaning, 10 years ago, we were talking about the dollar sliding as a...
And which side were you on?
I think the dollar remains... if you read like Barry Eichengreen's book, Exorbitant Privilege, or you just study marginally the history of reserve currencies, you've got to really wrest. You've got to do some bad, not that we're not doing some bad stuff in the U.S., but you've got to really wrest away the reserve currency from Britain and now the U.S. It doesn't just happen overnight. Something's got to really drive it. And at least in my forward-looking view, there's nothing that wrests that away from the U.S.
Dan Greenhaus of Solus Asset Management, thank you so much for being with us this morning. Wonderful to have you.
I'm glad we finally got John out of the way so the three of us could do...
Absolutely not. He is back next week, so have no fear. And Annmarie, I want to hear more about your trip to Ecuador. Coming up, we're going to be catching up with Bob Michael of J.P. Morgan, former Deputy National Security Advisor Victoria Coates, Ted Mortonson of Baird, and Jill Carey Hall of Bank of America as we look to another day of headline whipsaw. This is Bloomberg Surveillance.
situations like this highlight the resilience of the U.S. economy.
There are some little pockets of inflationary pressures.
We will continue to see upward pressure in inflation.
We still think there will be 1, perhaps 2 rate cuts.
We continue to expect the Fed to cut rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning, live from New York. Welcome back to the second hour of Bloomberg Surveillance. Traders losing faith in a ceasefire between the U.S. and Iran, with ships still struggling to get through the Strait of Hormuz. Futures dipping, oil rising, employment and inflation data coming up with jobless claims and core PCE 90 minutes away. A key question, AMH, and it keeps coming up. How do you trade markets that really are completely at the mercy of headline roulette?
It's very challenging, especially when the facts on the ground have not changed. So do you go with the headline and the intuition potentially of where the market might be going with the President of the United States saying, or do you actually look at the facts on the ground, which haven't changed when it comes to this conflict? The Strait of Hormuz is effectively closed, or if you want to say controlled by the regime. And yesterday, even though the White House kept saying they saw an uptick, there was no uptick. It was 0 to 4 vessels that maybe got through the Strait yesterday.
And a real question here of what was agreed upon in the ceasefire, what wasn't agreed upon. Questions of whether Israel had agreed also to cease some of the attacks on Lebanon as part of that or not. Conflicting conversations coming out of both sides.
Yeah, which is why I think a lot of investors probably will just want to stay on the sidelines until there's a little bit more clarity potentially coming out of these Islamabad talks over the weekend, because there has been just a ton of noise coming out of not just Tehran and the United States, but also what Israel's doing, and will they listen to the United States, depending on if a ceasefire in terms of if Lebanon is agreed upon or not this weekend. So there's a lot of noise right now, and I think that's why individuals just have a lot of questions, and there's not a lot of clarity, especially when the President of the United States very late last night says he's keeping all the military hardware in the region as basically a just-in-case policy.
In the meantime, yesterday, markets had a great day in terms of risk on with this belief in a ceasefire. We saw a 2.8% gain on the NASDAQ, a 2.5% gain on the S&P 500 today. We just take some of the heat out of that rally, down about 1/3% for the S&P and the NASDAQ. Russell 2000 more interesting, down 0.7%. As people look to the potential suppressive impacts on growth, take a look at what's happening in the yield space. A little bit of a bid into bonds, which is interesting in light of the direct correlation between bonds and oil prices recently, and especially given the volatility yesterday. A real sense of paralysis in the bond space, 4.28% on the 10-year after a pretty tepid auction yesterday. And all of it really has to come down to the price of crude. And when you take a look at the June contracts, both Brent and WTI, both up more than 4%, but still below $100 a barrel, 98.59 on Brent crude, and for WTI, $91.46. Coming up this hour, Bob Michael of JP Morgan Asset Management, with crude heading back toward $100. Former Deputy National Security Advisor Victoria Coates with the Iran ceasefire under threat, and Ted Mortonson of Baird as investors tap the brakes on the tech rally. We begin this hour with stocks sliding and crude climbing once again. More cracks appearing in that fragile Iran ceasefire. Bloomberg's Tyler Kendall joins us now from Washington, D.C. Tyler, what's the latest?
Yeah. Hey, Lisa. Good morning. Well, this White House says that the diplomatic process is continuing as the U.S. confirms that direct talks will be held with Iran this weekend, being led by Vice President J.D. Vance. And although reporting from the region indicates that Iran's attacks against Gulf state energy sites have appeared to decrease overnight, at this point, the ceasefire is still very tenuous. And that is partly because Iran is demanding that Israel stop its attacks in Lebanon, even as the U.S. says that Israel's separate front against the Iranian-backed militant group Hezbollah was never part of any deal, and President Trump downplays that it could derail the diplomatic process. In fact, Vice President J.D. Vance did say yesterday that Israel has, quote, offered to check themselves a little bit when it comes to Lebanon in a bid to help grease the skids when it comes to the negotiation process, as Israel confirmed yesterday that it had conducted its single largest day of strikes against the militant group. Now, President Trump did reiterate in this post yesterday on Truth Social that the U.S. stands ready to redeploy and resume military operations if Iran does not adhere to the ceasefire, and until a full agreement is in place, putting that emphasis on the need for the Strait of Hormuz to reopen. Because as Annmarie just mentioned, data analyzed by Bloomberg News shows that only about 3 vessels left the waterway yesterday amid what is an 800-vessel backlog. Now, Lisa, yesterday President Trump did meet privately with the NATO Secretary General Mark Rutte, and a person familiar tells Bloomberg News that he demanded that European allies put forward tangible plans to the U.S. on how they intend to help open the critical waterway in the next few days.
Heather Kendall, thank you so much for that. We'll be catching up with you throughout the day. Here's the view from Wall Street this morning. Bob Michael of J.P. Morgan Asset Management writing, the market is starting to unwind the tail risk associated with the global economy that would have to live with oil above $100 for a protracted period. Bob joins us now in our New York studios, which is a wonderful thing. Bob, great to see you.
Happy to be here.
Do you think that it's appropriate to remove some of the wagers on oil being below $100 a barrel for a protracted period of time?
Well, that's a complicated question. I think the best answer is we can live with oil $100 a barrel for a while. I think what the administration has done a good job of doing to us over the last year plus is to train us. And we look for signs of when is the rhetoric at a high, but they're starting to look for an exit. And we're starting to see that now. And I think that's why the markets are so optimistic. If we go back to tariffs, if we think about Greenland, if we think about Venezuela, at some point the rhetoric is very high, but the administration finds an off-ramp and exits. And I challenge you to tell me that all three of those things have been buttoned up. They're all still going on in the background. And it feels like we're on the same kind of off-ramp here. That's pretty good for the markets.
So yesterday we saw people have faith in the idea that the escalation in rhetoric at least had peaked, and we at least are coming to that off-ramp. It's almost exactly following the time frame of Liberation Day last year. I'm just wondering whether you think it's viable in an ongoing fashion, even during some of the question marks around how durable the ceasefire really is.
So we do, because there's been significant repricing across markets, especially in the bond market. Investors are caught a little bit offside for an actual off-ramp. I don't know that you need a ceasefire for the entire 2-week period. You probably need one for the back half of the next 48 hours. Enough time for everyone to meet in Islamabad and to iron out details of what an off-ramp could look like. And then I think over the next month, we're going to see this in the distant rearview mirror, even if oil stays at $100 a barrel, because it's going to take time to get the fiscal oil to where it's needed.
So you think these Islamabad talks are real and credible?
I think they are. I think they're essential for the administration if they're genuinely looking for an off-ramp. It sounds like for the last 3 weeks they've been looking for that. I feel Vance is on his way there. The Israelis will be there, and something will come out of them.
But when it comes to this gap between the Iranians and the United States, they don't agree on anything right now.
Right. Everyone, it's classic bargaining. You want this, somebody else wants that. You'll find a way to meet in the middle. There are lots of things that the U.S. can do. Yesterday, I listened to General Kane. He declared victory. You listen to Vance. He declared victory. They've already started the process of saying, look, the primary mission was to mitigate a nuclear threat. We've done that. We'd like the Strait open. We'll see if we can get to that. If not, we supply enough of our own oil, we'll just move on.
So with fixed income, what does buy the dip mean? Because we've seen that certainly in credit, with investment-grade credit spreads moving down below at one point where they were right before the war took place. We just heard earlier this morning Keith Lerner talking about how he went wholesale into high-yield bonds because he sees opportunity now. Is it more the credit risk side, or is it more the government bond side, with expectations that inflation will ultimately continue on its downward path?
It's everything. It's just an acceptance that investors are underallocated to fixed income. Equities have bubbled higher for them over the years. They've allocated a lot to alternatives. They're looking for opportunities to get into fixed income. I've been in Houston for the last couple days meeting with clients. They don't want to miss this backup in yields. They want to get into the bond market. It starts with where is fair value. I think the Fed is in hibernation mode. I like that. I like a 3 5/8% Fed funds rate. It's solid, It leaves it at about 0 on a real basis if you deflate it by headline inflation. That's okay. It also leaves yield in the bond market. The 2-year should be within touching distance of that. It's probably about 10, 15, 20 basis points too high. And the 10-year, we think, with a 3 5/8% Fed funds rate, either side of 4%. You're a little bit over 4 1/4. That looks okay. And Keith is right. Credit spreads are attractive. All the problem credits had financed themselves in the private credit market. Is that a separate problem? Is that all part of the same credit problem? We'll see over the next 18 months. But for now, the bond market looks pretty good. It's held in phenomenally well over the last 6 weeks. And investors don't want to miss this opportunity the way they did last year with Liberation Day.
Well, neither do companies, right? We're seeing a rash of bond deals coming to market, a lot of issuance. We saw the most issuance ever globally for corporates in March. And now it seems like anytime there's a window, everyone wants to come in.
And hasn't it gone well?
It has gone incredibly well. And all of the debt sales have been oversubscribed.
And what
and
does
then
that
some.
tell you?
Well, exactly.
It tells you there's money there. It tells you that we in the bond market look at corporate earnings, we look at profitability, we look at leverage, and we're okay.
Given that, isn't there a dissonance between the belief that inflation will go down over time while also seeing the animal spirits come back to markets with so much money still available and people looking through even $100 a barrel in terms of oil prices saying consumers can withstand that? Listening to Ed Bastian over at Delta, we're optimistic. We're seeing customers absorb the higher prices. I mean, can't you bake in higher inflation? Doesn't it have to be one or the other, animal spirits or potentially a bid into duration?
Well, I think we've crossed that divide. I think we in the markets accept that a 2% inflation target is a myth. We haven't been there in half a decade. It didn't feel comfortable when we tried to get there and we were printing 1.7, 1.8. It's too low for an economy the size and complexity of the US. 2.5 feels like the new 2%. And we're a little bit above that. Because we've got transitory inflation because of the energy shock. That too may or may not fade. But I look at our analysis, I read Mike Ferroli's stuff a lot. Even with where energy is and the probabilities of this being extended, we've got inflation, if you look at headline and core, between 3.5% and 3% for this year. But we have real GDP at about 2.25%. So what we're saying is this economy can absorb higher inflation than 2%, even inflation around 3%. And the Fed probably doesn't do anything because they went into the last meeting still a little bit concerned about the labor market. Now they're probably more balanced, so they're going to sit on their hands.
Michael, you're going to be sticking with us of JP Morgan Asset Management. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The White House saying Vice President J.D. Vance will lead direct talks with Iran and Pakistan. Vance will be joined by Special Envoy Steve Witkoff and Jared Kushner. The first round of talks is set for Saturday morning, local time. President Trump lashing out at NATO after a meeting with the Secretary General Mark Rutte. In a post on Truth Social, Trump writing, quote, NATO wasn't there when we needed them, and they won't be there if we need them again. Rutte saying he and Trump had a frank and open discussion. And the U.S. is considering lifting sanctions on Venezuela's central bank to facilitate the flow of billions of dollars into the country's economy. Sources telling us here at Bloomberg the move would allow proceeds from oil sales to circulate more freely through Venezuela's financial system. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, pushing for peace.
We have a negotiation that's supposed to start this weekend. We're going to see if we can make more progress here in the days to come. I'm optimistic that the Iranians are going to be smart, that they're going to negotiate in good faith.
Former Deputy National Security Advisor Victoria Coates joins next. This is Bloomberg Surveillance. Good morning. Yesterday's solid risk-on feel turning to just a sense of skepticism right now in markets. Futures lower as we head toward the opening bell. 0.4% decline on the S&P. Yields a bit bid, just a bit, 3.78% on the U.S. 2-year. Dollar fading just a touch, continuing the slide that it saw yesterday. And Brent crude solidly above $98.62 when we're looking at the Brent June contract, up 4%. Under surveillance this morning, pushing for peace.
We thankfully, at this point, I think, have a ceasefire, thanks to the leadership of the President of the United States. We have the Iranians promising to open the Straits of Hormuz, and we have a negotiation that's supposed to start this weekend. That's the truth. I think it's a good first step. We're going to see if we can make more progress here in the days to come. I'm optimistic that the Iranians are going to be smart, that they're going to negotiate in good faith.
Here's the latest. Vice President Vance gearing up to lead direct talks with Iran on Saturday, with fighting in the Middle East threatening to derail an already fragile ceasefire. Former Deputy National Security Advisor Victoria Coates writing, "The odds of Iran sticking for the full 2 weeks is pretty small in my book." Victoria joins us now. Victoria, thank you so much for being with us. So what are you gleaning so far from a pretty uneasy ceasefire, if you could even call it that, for 24 hours beset by attacks and a lot of arguments between both sides?
Yes, this is a pretty dicey period, and this is standard for this kind of arrangement. If you think back to the Gaza war, the early ceasefires were extremely delicate. There was a lot of pushing at the edges by both sides, and it took a long time to get to a durable deal under President Trump last fall. So I think we're going to see a similar kind of jockeying for position here. But the interesting thing here is that the Iranians really don't have any cards beside the Strait of Hormuz. And one thing I've noticed is that it's going to be a declining asset for them, because the entire region is talking about ways going forward they can circumvent the Strait. So Iran's going to try to play that card as hard as they can right now, get as much as they can out of it. But I think their ability to do that going forward is going to be quite limited.
Victoria, when it comes to the Strait being open as normal, but with these strings attached, the Iranians basically making sure you have to have a payment, whether it's yuan or Bitcoin, would that be a success for the United States? Yes, there would be more of an uptick of vessels, but that means Iran fully controls this key waterway.
No, I think that's absolutely what we're going to be working on going forward. And what you're seeing the Iranians do is essentially function like a mafia group. They're trying to shake down the rest of the world to get energy out of the Gulf. And so, yes, they are demanding crypto payments, which is kind of comical. But as I said before, I think their ability to do that long term is not going to be there for them. And the other thing it shows us is that they are desperate for money at this point. Their economy is absolutely on the rocks, and they've shut down their internet for now 35, 36 days. So nobody's done that before. And I don't think anyone's really forecasted the kind of damage that's done to that economy and what happens when they open it back up. What are the Iranians going to do when suddenly, the ATMs are full again, that kind of thing. It's really a very difficult situation for them. So I think they're thinking very short term right now. They're just thinking, how do we get cash out of the Strait of Hormuz so we can survive another day?
This is still leverage that they hold. How do you think they're going to use this at the negotiating table on Saturday? What would be acceptable to the United States?
Well, that's the thing, is this is all they have. This is their leverage. Otherwise, their ability to inflict harm on the United States, their neighbors, on Israel, is getting more and more limited. That was really the point of Operation Epic Fury, was degrade their ability to inflict that harm and also their ability to reconstitute it. And the Secretary of War and the Chairman of the Joint Chiefs yesterday laid out a very detailed case about how that ability to reconstitute their missiles, to restart their nuclear program, had really been destroyed. So all they really have is the Strait right now. And as I said, that's a declining asset for them. So they don't have a lot of cards. And I think that's the point that the Vice President and the special envoys will be making to them.
Victoria, can a post-weekend off-ramp for the administration include leaving the Strait of Hormuz in control of the Iranians if they accept U.S. dollars and some conditions about how the funds are used?
In terms of accepting U.S. dollars
Only
as
as
payment?
tolls, yes.
As toll. I mean, that is certainly something, although I actually would prefer them not to have dollars. I think the economic leverage is the other really strong point the vice president's going to have in his pocket. You know, the Iranians can't restart their economy without broad sanctions relief. I mean, that's just not going to happen. I don't see China doing anything material to help them economically, and they've alienated countries like Qatar, who might have been willing to help them in the past. And I think it's notable that Qatar went to the United Nations yesterday and said they want to hold the Iranians economically liable for the damage that was done to their oil field during the war. Very interesting development there. So I would prefer not to give them dollars. That's a nice hard currency for them. So I wouldn't really see that as a give point for Iran.
Victoria, it was sort of interesting to me that Bob brought that up because a lot of people are talking about China maybe coming closer to Iran and the petrodollar becoming the petro yuan, this idea that they could enter into the primary relationship, considering their role as the major buyer right now from the Middle East. Do you think that that is exaggerated and that, frankly, Iran has no friends and that there isn't necessarily any push toward China in that kind of material way?
Well, that's what it has been for the last 5-6 years. That China has been the primary buyer. They've bought in yuan, and then the Iranians can use that currency to buy things from the Chinese. So it sets up a nice little loop for China, and that has been the case. It hasn't made a lot of people in Washington happy, but it's not that great of a threat to us because I don't see anybody else. I don't see the Saudis or the Kuwaitis or the Emiratis or the Qataris particularly interested in taking yuan for their product. So if it's just Iran and that loop is keeping Iran out largely of the broader global economy, that doesn't make me all that unhappy.
Victoria Coates, former Deputy National Security Advisor, thank you so much for being with us. Bob, this to me is one of the key questions, right? How much do we start to see other currencies replace the dollar and sort of the end of the petrodollar regime that began in 1974 and has lost a little bit of clout?
I do think there is room for the administration to leave the Strait in control of the Iranians if they accept only dollars, and there's some methodology for how the dollars are distributed. What are they used for in Iran, and do they go to Qatar to help rebuild some of the fields? I expect that to be part of the off-ramp discussion.
To do that, though, the United States would have to lift their own sanctions on Iran. Iran right now has no access to the SWIFT banking system. You can't actually transact in dollars in the country unless you have physical hard cash, which a lot of Iranians like to hold on to. So it'd have to go to some sort of escrow account for humanitarian aid. Is that what you're thinking?
Come on, AMH. We've had this administration for over a year. Everything's on the table. Everything can be recrafted. So I have confidence that the details will be worked out over time, or like everything else that we've seen with tariffs, with Greenland, with Venezuela, they won't be worked out yet, but they'll be in the rearview mirror.
I think one of the big questions that a lot of people have, and something I keep hearing, is who is doing the negotiating in Iran? It seems like there are conflicting signals coming out of different parts, and it seems like there are attacks coming out of different places. So is there enough of a cohesive regime to actually come out with any kind of deal that can actually be agreed upon?
Well, I think it was interesting when I think it was the foreign minister or Mohammad Ghalibaf actually released a statement for the Supreme National Security Council, because in Iran it is a deliberative body when they try to speak and everyone almost gets a vote. I believe the individuals that would likely end up showing up in Islamabad would be Ghalibaf and the foreign minister. But really at the end of the day, it is this deliberative body which has a lot of IRGC influence and of course the Ayatollah, who we have not seen yet.
How much do you follow all of the different iterations that come out every day, Bob? And how much is it sort of a question, just buy bonds? It seems like there's a lot of money out there, and frankly, you can't really trade off the headlines.
No, I follow it constantly. I'm interested. I think AMH makes a good point. Whoever shows up in Islamabad, that's who you're dealing with.
Yeah, that's going to be what we're watching over the weekend. Coming up, Ted Mortonson is going to be joining of Baird as the tech rally stalls out just a touch. Plus, Danny Berger comes on with your morning movers. CoreWeave shares jumping on an expanded AI deal with Meta. To Bob's point earlier, lots of deals getting done right now and lots of money that are looking to get put to work there. This is Bloomberg Surveillance. Good morning. coming to another day with a complete shift in sentiment. Yesterday was very much risk on, almost a 3% rally in the NASDAQ. Today, fading that just a touch with questions around what a ceasefire means if people are still lobbing bombs at each other. Right now, we're seeing NASDAQ futures lower by 0.4%. Same on the S&P. Russell 2000 seeing a more significant decline near session lows, down 0.8%. A little bit of a bid into bonds, kind of a complete stagnancy here as people understand the dueling risks for the Federal Reserve. Essentially flat, 3.78% on the 2-year. 10-year yields 4.28%, and we have an auction coming up later today at 1 p.m. of 30-year bonds, and we have 4.88% rounded up on that. And really the entire story has to do with crude. Right now it is a crude market, and right now crude is inflecting higher, up more than 4% on both Brent, $98.57, and WTI, the June contract, $91.50. A real question here about what will actually turn the tide a material way. Bob Michael has been with us for the hour. And Bob, you've been saying ultimately oil above 100 is actually okay as long as it remains stable and as long as the economy can keep chugging along.
Yeah, I've been saying that. We've asked our credit analysts to model corporate profitability. We see a couple things. One, revenues tend to come down a little bit because there will be some demand destruction. Margins will come in a little bit. But corporate profitability is still there. You're not in recession. You're not in desperate times for corporate America. The U.S. can withstand $100 oil. Ed
Bastian seems to agree and is raising prices. So is Scott Kirby over at United. And frankly, we might see more of that with earnings season coming up, starting off in earnest next week. 2 hours away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa, one thing that's certainly not slowing down amid all of the macro headlines is deals for AI. CoreWeave and Meta reaching a new agreement in which Meta would spend $21 billion with CoreWeave. This adds to a $14 million already agreed between the two of them. This is around data centers. The agreement's going to be spending from next year, 2027 through to 2032. Already Meta is building out its own AI capabilities, but it needs more. It's going to do so with CoreWeave that houses NVIDIA chips in its centers. Elsewhere, some of the more macro-related news. Intel has been on an absolute tear, gaining for the past 6 straight sessions. It was the second best performer in the S&P 500 yesterday to close at a 5-year high. Some individual things happening with Intel, but also getting caught up in the risk on sentiment yesterday. Just want to point out that that is reversing with the market, not undoing everything it did yesterday, but it's still down nearly 2%. Similar story when it comes to the airlines. They had a pretty big day yesterday, too, up at least 3%. In the case of United, it was up closer to 7%. That, again, comes in this morning as the price of oil moves higher. All of these, though, still trading below their pre-war levels. Lisa?
Thank you so much, Danny. On our radar this morning, the White House confirming direct talks with Iran are set for Sunday in Pakistan. Vice President J.D. Vance leading a high-level delegation, which includes Steve Witkoff and Jared Kushner. Meanwhile, crude heading back towards $100 as the Strait of Hormuz remains effectively closed. Tehran blocking passage through critical waterway as Israel continues strikes on Lebanon. And finally, President Donald Trump repeating his criticism of NATO during a closed-door meeting with Secretary General Mark Rutte. Rutte saying the meeting was frank and open.
He is clearly disappointed with many NATO allies. But at the same time, I was also able to point to the fact that the large majority of European nations has been helpful with basing, with logistics, with overflights, with making sure that they lived up to the commitments.
A bit of a different tone coming from the president, posting on Truist Social, quote, NATO wasn't there when we needed them, and they won't be there if we need them again. Really going to the question, AMH, of whether you're going to end up with some sort of withdrawal, wholesale repudiation of NATO. We've seen that rhetorically, but is there going to be more of a move in that direction?
Well, rhetorically, it's been on the table, and the press secretary even said that this week. Those conversations are there. I think probably it's a carrot and stick approach from this administration because they want to see NATO to step up more. We have reporting that the president in the U.S. is asking for specific commitments from NATO countries to help basically police the Strait of Hormuz. And I think one thing to take into account is we can't be naive to think that this was a free and open waterway. It's been free and open because the U.S. Navy and Fifth Fleet has been there for years, making sure that it was a free and open waterway. And I think potentially, given the volatility between Tehran and Washington, the U.S. is saying, well, if we can't make sure it's going to be safe, then European countries need to step in.
There are a lot of things to worry about right now, but NATO is the one I worry about the most. I think it's sacrosanct that NATO and the Western alliance remain intact. And yes, there could be little squabbles here and there, but it absolutely cannot come apart. So that's a priority, in my view, above all else.
Why is it such a key risk in terms of your seat and what you're looking at?
Because it creates stability across the Western world. It helps to create global stability. The last thing you want is any fragmentation of that. I think it's okay to have a little family squabble, but then come to some sort of agreement going forward. But I think this is a sacrosanct alliance.
I had forgotten that Greenland was still on the table, but evidently it was. So it sort of highlights all the issues that are percolating out there.
Big pile of ice, I think is what the president called it yesterday.
I would love to visit that big pile of ice. I can just say Iceland was fantastic. Moving on. Turning back to Wall Street, stock futures turning negative after Wednesday's global relief rally. The tech-heavy NASDAQ on track to snap a 6-day winning streak. Ted Mortonson, managing director of Baird, saying the AI trade is under the microscope. And Ted joins us now for more. Ted is someone who I am so looking forward to speaking to because you have had experience in the military. You have had experience of what it's like on the ground, while also analyzing tech companies. Before we get into the tech trade, can you just give us a sense of how much we're learning about technology and war during this period right now?
Well, thanks, Lisa. I think the whole technology background is changing, and I think we're now entering the world of AI. I mean, if you look at what Palantir is involved in, not only in the U.S. government and CENTCOM in Tampa with Admiral Cooper, but the Israelis are also using it. So I think you're seeing the first cleansing of AI in a war footing, and the results speak for themselves. I mean, 30 days, you've basically decapitated a country.
So when you say cleansing, what does that mean? I mean, in terms of the AI investments, and not to putting aside the geopolitical moment and putting aside the actual war itself, how is technology being deployed, and how are we seeing who the winners and losers are going to be going forward, not just in a military sense, but just in an all-in AI sense as a result?
Well, so if you look at AI is not only economic, but it's also military. So talking about NATO, they got to get going on AI. They have to do, they're going to have to do these sovereign fabs to understand it. The U.S. is so far ahead, along with China, and this is how war is going to be waged in the future. So if I had to say what stage we are in a baseball game, we're not even in the first inning yet. The amount of AI that's being embedded in technology into weapon systems is in its infancy. So we are just starting. Look what Anduril, look what a lot of the defense companies are doing. They're embedding that technology into next generation weapons that we have not seen yet. So we're just at the cusp of it. But I think if you look at the performance, it works.
Shyam Sankar of Palantir did say that this is the first war where it's going to be basically AI-driven.
Right.
When you talk about AI in weapons, do you mean autonomous weapons?
So picture, the F-35 that was developed, the new fighter that the Navy and the Air Force are using. It's like a player coach on the battlefield. I mean, it allows you to take an immense amount of data for the pilot and actually be that coordinator in the air. Now, what you're going to see in the future, you're going to see drones from Anduril on both sides of the wing. And this is a change in military tactics where you're going to send stealth drones into the battle instead of, in my era, where you had to fly down the streets of Baghdad. It's a little bit different. You're putting the pilot at risk. Now, with advanced targeting and these advanced stealth drones, pilot will not be at risk as much as he has been, and the targeting that you're seeing in Iran will be much more prevalent.
Well, are there mistakes, though? Because the administration did go after a school accidentally.
Well, I think, we can go into that. I mean, there's always a human. There's always going to be a general and an admiral and a whole bunch of staff that is going to be cleansing this data, and they're ultimately going to make the decision. It's not AI's driving the... AI is a tool, I would say, at this point.
Ted, how far away are we from a tool that shoots down drones or intercepts drones?
It's in development. A lot of the tech companies that actually I'm covering right now, we're just on the cusp of that on high energy. You're seeing the Navy deploy lasers right now. You're seeing the Israeli government, on Iron Dome. Now they have lasers that you're not seeing, obviously, in the press because they don't want you to see it. That's number one. Number two, the ability of doing high energy systems. Basically, you're frying the components of an Iranian drone. It just basically falls out of the sky. Now, are we there yet? No, it takes time. But thank God you're American, because this is on the drawing board and it's going full bore.
So it feels almost trite or perhaps insensitive to say, well, what's the trade, given the fact that we're talking about life and death and war and all of these issues. At the same time, is there a tell with respect to which technologies and which companies are getting ahead during this period militarily, and that they will be winners down the line when it comes to commercial uses? In other words, are you seeing winners and losers in the AI space more broadly for the economy shake out right now?
It's a fantastic question, and let's just boil it down to a little bit in simplicity. If you look at the conflicts that we have been in the last year, we have used a tremendous amount of weaponry. So advance over the horizon targeting. Those weapons don't grow on trees, okay? The other thing is, when you're having a 30-day pace of a conflict like this, you're depleting your stocks, right? So when I talk to my portfolio managers, we are getting people over those defense names, because if you look at the president's budget of $1.5 trillion on the defense budget, the procurement of weapon systems is up triple digit off that. So we have 3 to 4 years of 25-30% growth for some of these companies in that defense chain, the silicon chain. The next generation, like the Kratos or the AVAVs, or when I hope Anduril comes public, because it's a fascinating company. All of those next generation systems have to be rebuilt, and it's going to take years.
So do you think that right now people are not bullish enough on a lot of these technology names, even as they turn into a safe haven?
You have to be in the weeds to pick these names up. So you have to do this full time, and you have to listen to 70+ conference calls during an earnings season, and you got to pull it together, because it's not going to hit you in the face.
Claude can't do it, evidently. Well,
not yet.
Ted Mortonson, thank you so much for being here. Ted Mortonson of Baird. And this is the reason why you see the exuberance. This is the reason why you see CoreWeave coming out with yet another issuance. This is the reason why you've got so many deals, because of the optimism of how this is going to transform what we're going to see down the pike.
Well, everything Ted's talking about, you need capital to keep developing, to roll out, to test. And it doesn't work perfectly maybe the first time, but down the road it will. Unless you're part of financing these things, you're going to be left behind as well.
And that's what a lot of people keep saying as they pour money into a lot of these offerings, into a lot of these deals. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anna. Yahira.
Hi, Lisa. Iranian officials say Israel's strikes on Lebanon violate the terms of the ceasefire agreement. Israel launched its largest assault on Lebanon yesterday since the start of the war. The country's health ministry saying at least 182 people were killed and hundreds were wounded. And in markets, shares of CoreWeave are rising 2.3% following the announcement it's expanding its AI infrastructure pact with Meta. A new $21 billion commitment to CoreWeave comes on top of a prior $14 billion commitment. The new spending will run between 2027 and 2032 as Meta is aiming to boost its own AI infrastructure. And Ecuador's President Daniel Noboa telling our own Annmarie Hordern he would welcome U.S. troops to help confront the security crisis in his nation.
What I focus on is the willingness of this U.S. government to finally go after narco-terrorists in our region. Maybe the form is not ideal, but the true intention and the plan, I think it's a good one.
Noboa says a U.S. troop deployment could happen as early as this year. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Was it fun down there in Ecuador?
It was interesting. It used to be one of the most peaceful countries in the world, and now it's rated one of the most violent because of the transnational gangs. And he's going after them with an iron fist, and already we're seeing U.S. joint military cooperation, and he's asking for even more and would welcome U.S. troops on the ground.
Here I was thinking that you went to the Galapagos Islands to,
not quite.
Check out the turtles.
Darwin, no,
yeah, not so much. Up next, staying power in stocks.
This is a sigh of relief
that we do think has some staying power. The bull market that started in October of 2022 has further to go.
Jill Carey Hall of Bank of America joins next. This is Bloomberg Surveillance. Seeing a bit of a retracement from yesterday's optimism, futures lower, but not necessarily taking back all of yesterday's gains. Down just about 0.25% for S&P futures. A bid into the two-year yield down a basis point to 3.77%. The dollar losing just a touch, weakening to 98 on the DXY index, and Brent up 3% to $97.76. Under surveillance this morning, staying power in stocks.
This is a sigh of relief that we do think has some staying power. But again, as we've been saying, the devil will be in the details over the next several weeks. We continue to be believers in the U.S. in terms of its capital markets and the risk-reward opportunities. The bull market that started in October of 2022 has further to go.
Here's the latest. Stocks falling on concerns about a fragile U.S.-Iran ceasefire. However, small caps outperforming year to date despite the headlines whipsawing markets. Jill Carey Hall of Bank of America writing, if a prolonged conflict raises stagflation risks, small caps have typically held up better than large caps. I'm kind of stumbling over this because this is very hard for me to understand. Jill joins us now. Please explain, because clearly it doesn't really seem like a logical thread that stagflation means good things for small caps.
Right. I mean, it doesn't typically mean good things for equities. Historically, equities have underperformed most other asset classes during stagflationary backdrops. But if those stagflationary risks continue to percolate, we've typically seen that small caps have held up better than large caps. I mean, right now they have more exposure to industries that are, positively levered to higher oil prices like energy and parts of industrials than industries that are hurt by higher oil prices like consumer. So, we've seen earnings estimates rising, since the start of the conflict. And that's been true in mid and large caps as well. So we've actually seen earnings hold up well. And, small caps have actually tended to hold up well in environments like when we looked at the 70s and the 80s. So it is stagflation isn't good for equities, but small caps have tended to hold up better. We got to watch rate cuts or potential for rate cuts, though, since small caps have obviously been very sensitive to the Fed.
Well, that's exactly where I was going to go. Ultimately, small caps have traded pretty much in tandem with Fed expectations. And now the longer stagflation risks remain on the table, the more the Fed's not going to be doing anything. So how is that going to be helpful? Can small caps continue to perform if the Fed doesn't cut rates further?
Right. I mean, I think you get some offset from the benefits that we see from, higher oil benefiting earnings from, going into this, we started to finally see a manufacturing recovery and earnings recovery. So there have been some positives and GDP growth is holding up well. Now, if we are on the brink of Fed hikes, then I think that becomes much more problematic for small caps. Right now we had seen rate cuts start to get priced out. They got a little more priced in after the last day or two, but I think the hikes still seem a long way off, according to our economists at BofA. So that's something that we're watching closely. The Russell has been very tethered to rate expectations, a little bit less so in recent months, especially as that earnings and manufacturing recovery has taken hold. So we would definitely stick with less levered small caps, stocks that don't have that refinancing risk. So I do think you need to be selective within the size segment given those risks.
Well, not optimal. Does your work tell you that corporate America can survive at $100 oil for several quarters, or does that just create too much pressure on their profitability?
Right. Well, our base case is that, we see this resolve within the next several weeks, 2 to 4 weeks. And, oil prices, it depends how long they're above $100 a barrel, because then if that conflict extends into, the full second quarter, then that becomes more risky to growth. And usually the rise in oil prices tends to hurt consumption with like a 3 to 4 quarter lag. So there is risk the longer this plays out, then that has a lagged impact on hurting consumption later in the year. Corporates have been pretty resilient, and energy costs are a relatively small proportion of companies' operating costs. So overall, corporates have seen upward estimate revisions during this conflict, but certainly keeping in mind the impacts to the consumer if this plays out longer and oil does stay above that $100 a barrel level.
If the Fed doesn't cut rates this year, but the corporate bond market remains open for financing, is that enough of an offset for you?
I think, like I said, we are still looking for 2 Fed cuts this year. Our economists are expecting they're now occurring a bit later in the year, so starting in September rather than over the summer. So I think there's a little room, but even if rate cuts get priced out, as long as we're not seeing hikes and the economy is holding up, we're seeing manufacturing continue to recover, we're seeing profits continue to surprise to the upside, that does provide somewhat of an offset. But I think, every 25 basis points that the Fed cuts rates is a few percentage points on small cap earnings, given those refinancing risks. So again, I think one needs to be more selective within small caps. Our analysts at BofA cover about 1,000 small and mid cap companies. There's a lot of options out there rather than just owning the Russell 2000 to be able to identify, okay, who has more exposure to manufacturing recovery, to CapEx in the U.S. Small caps tend to be CapEx beneficiaries, and who doesn't have that leverage and refinancing risk.
Jill Carey Hall, thank you so much for being with us this morning. Jill Carey Hall of Bank of America. We are looking at what the ceasefire actually looks like, whether it can stay. Some commentary coming from Iran, AMH, saying that they will not abandon the Lebanese.
Right. So I think when it comes to Lebanon, this could be a stumbling block for Saturday. So you have 2 statements coming from the president, Masoud Pezeshkian, saying that Israel's renewed incursion to Lebanon is a blatant violation of what they believe was the original ceasefire agreement. And then the Speaker of the Parliament, who potentially is this individual that might be one of the individuals that goes to Islamabad, Ghalibaf, he is saying Lebanon, the entire resistant access as Iran's allies, form an inseparable part of the ceasefire. So they are making Lebanon a condition to the ceasefire, which is why I think it's going to be a long road until those talks on Saturday morning.
And pretty much every commodity strategist and geopolitical analyst says the same thing. Bob, I would love your thoughts on what your compass is on days like this, which seems to be like every day, and there's a lot of headline risk. What's your compass to figure out exactly what is prudent investing?
We think about valuations across markets. And for fixed income, with the backup in yields, that's the first sign that we should be looking to add. We didn't think about our credit risk and what corporate profitability looks like. And for us, it seems to be holding up well, as long as we don't see a significant escalation from here. It feels like with an administration looking for an off-ramp, we have to watch the weekend talks. We'll see what comes out of that. But we've seen this movie before over the last year, actually several times. So we shouldn't dismiss that an off-ramp is impossible given what everyone's asking for today. We've seen that things can be negotiated and the administration can move on to other things. So right now, we like the bond market in here.
Bob Michael, thank you so much for being with us for the entire hour. Bob Michael of JP Morgan Asset Management. Coming up in the next hour, Jim Bianco of Bianco Research, Tom Fitzgerald of TD Cowen, Nela Richardson of ADP, and Michele Weaver of Morgan Stanley as we get key economic data coming out, jobless claims, and core PCE. This is Bloomberg Surveillance.
We're just sort of back to the narrative, really, of the last 12 months.
There's so much complacency in the market.
This can really overshoot to the upside.
It doesn't reduce market volatility, it actually increases it.
Volatility is higher. We have to learn to live with it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Feeling more and more like a group therapy session live from New York. Welcome back to the third hour of Bloomberg Surveillance. Traders curbing their enthusiasm about the ceasefire agreement in the Middle East. Futures dipping, oil rising, ships still struggling to get through the Strait of Hormuz. 30 minutes until key economic data points that are coming out. Jobless claims, personal income, personal spending, core PCE. How much can we actually glean, AMH, about what the economic ramifications are from this conflict?
Well, potentially we'll get some of that in the data, but does it really matter when all eyes are on Saturday and whether or not these ceasefire talks become really credible? And do we get clarity following them, given the fact that just moments ago we've had two leaders in Iran, the president and the head of the parliament, basically saying the situation in Lebanon is not toned down and curtailed, then these ceasefire talks are meaningless. So I think that's a key risk right now. And I feel like the market reacted so heavily on this idea of an off-ramp and a ceasefire. It is going to be a very long road there.
Which is something that Halima Croft raised in her note from RBC.
How messy it's going to be.
Yeah, and how difficult it is to really get any kind of new normal back on the ground, especially given that Iran does not want to give up control over the Strait of Hormuz. A question here about what's happening on the ground with oil majors as well, because right now we're seeing that, yes, on one hand, they should benefit from all of the increases in oil prices. On the other hand, actual facilities have been damaged in the region with a real question of what it's going to cost to rebuild.
So we saw this with Exxon, and now we're seeing with Chevron. Chevron is saying that production fell as much as 6% in the first quarter, due in part to what's going on in Iran, and they pinpointed decline and reduced output to the Persian Gulf region and Israel, and downtime in operations in Kazakhstan. So to your point, it's a double-edged sword for these major oil companies. Yes, a higher oil price is great for them, but it's not going to be a windfall. They have a lot of money they now need to reinvest to damaged facilities.
Yeah, and Bob's point, Bob Michael of JP Morgan, was that even with oil prices at $100 a barrel, Jill Carey Hall making the same point, a lot of U.S. consumers can keep spending. The U.S. economy can keep chugging along. It's relatively resilient, which is a reason why people have been looking at how much economic surprises have been inflecting to the upside and why we're seeing so much resilience come through in the likes of Delta earnings and others. Now we're on to next week, what we get from the banks kicking off into earnings season, where we have to get some guidance from companies that are navigating all this.
And it's a really hard time to guide. A lot of things we've heard today has been no one really understands the duration, potentially, of when Iran would start to loosen their hold on the Strait of Hormuz. The White House said yesterday there's been an uptick. There hasn't been, 1 to 4, depending on how you are tracking it. Vessels went through the Strait of Hormuz. That is not an uptick. Goldman Sachs today saying Brent crude is set to average, if Brent crude is set to average $100 a barrel through 2026, if the Strait remains closed for another month. How, as a company, do you start to bake that in? Very challenging.
Right now, markets are relatively sanguine. Yesterday was a huge risk-on day. We saw a 2.8% gain in the NASDAQ in particular. Today, just a little bit lower, down 0.25% for S&P futures. NASDAQ down just about 0.1%. Russell 2000 getting beaten up a little bit more, down 0.6%. The bond yield, the bond space yesterday was relatively confusing, considering that initially a bid into bonds, then a pretty tepid 10-year auction. Today, a bit of a bid back into bonds, particularly at the front of the yield curve, 3.77%. 10-year yields 4.28%. Later today at 1 p.m., we do get auction of 30-year notes, 4.88%, down just a touch ahead of that. And really, the entire space is dictated by what's happening in crude. The June contracts for WTI and Brent, both below $100 a barrel. That's the good news. The bad news is that both of those are up more than 3% on the increasing tensions and questions around the ceasefire. 97.89 on Brent. Coming up this hour, Jim Bianco of Bianco Research with the relief rally stalling out. Tom Fitzgerald of TD Cowen on the health of the airline sector after Delta reported earnings yesterday. And Nela Richardson of ADP breaking down the latest round of economic data. We begin this hour with stocks edging lower after a fragile ceasefire between the U.S. and Iran. Jim Bianco of Bianco Research saying there is permanent risk premium in markets, even if the ceasefire holds. Jim joins us now for more. Jim, thank you so much for being with us. Let's start there. Is this market accepting a risk premium? And is it already baked in based on the fact that we've seen a lot more volatility and that this isn't going to be a conflict that is easily solved?
No, I don't think it is. And I've been listening to your show for the last half hour, and the overwhelming consensus is, does this end in a couple of days? Does this end in a couple of weeks? Does this end in a couple of months? Nowhere in this conversation is what happened with the Suez Canal in 1967. It closed for 8 years. And the ships that were stuck were permanently stuck, never to get out again. that scenario is not on anybody's radar right now. I'm not saying that that's the scenario now. I'm just saying that a protracted move is not on everybody's scenario. And secondly, even if it is a short-term move, the precedent has been set. You can't go back to the low risk premiums that we've had before this war started, because this could always flare up again, either from Iran or another country. So I think we're going to have to deal with higher risk premiums. But what happens with Wall Street is we say that we got to deal with high risk premiums, but then we invest like we're not investing or believing that there's going to be higher risk premiums.
Part of that is because we're conditioned by experience that there is an escalation in rhetoric, then a de-escalation in rhetoric, and then all of a sudden the U.S. economy keeps chugging along and, oh yeah, you've been left behind by this flood of cash going into risk assets. I mean, how much do you view the asymmetric upside of risk assets over the past couple of years as kind of dimming any kind of risk-off sentiment or even ability, frankly, to have a dip?
Oh, absolutely. I mean, you know, we've been fooled too many times, according to Wall Street, right? We were supposed to panic after COVID. It was a buying opportunity. We were supposed to panic after 9% inflation. It was a buying opportunity. We were supposed to panic after the fail of Silicon Valley Bank. It was a buying opportunity. And we were supposed to panic after Liberation Day, and it was a buying opportunity. So Wall Street's figured it out. I don't care what the news is. It's a buying opportunity. And that seems to be the way that they're operating with this right now.
I'm glad you brought up the 1957 Suez Canal crisis, because actually, Jim, a source mentioned to me this to me last night, talking about how much what's happening in the Strait of Hormuz could be akin to that. If it were, where should oil prices be trading today?
Well, if it is, what's the problem is that the world consumes about 103 million barrels of oil a day. Now, based on the estimates, we're getting about 90 million barrels a day or so, thereabouts right now. So there's a shortage of oil. So to put it very simply, somebody's got to stop consuming 13 million barrels of oil. Somebody's got to stop going to the gas station and filling up their car. Now, how do we do that? We raise the price. And we raise the price until we get 13 million barrels a day, I'm talking globally now, of less consumption. So the price is going to have to go up, and it's going to have to stay up, because if the price goes down, we're going to go right back to demanding 103 million barrels a day when we can't deliver that. Now, maybe over time we could build some pipelines and stuff to work around this problem, but that's a process that's going to take years, not it's going to take weeks.
What kind of price are you talking about? Bob Michael was just on. He was saying how the U.S. can live, and the U.S. consumer could basically live with $100 oil.
I think he's right that we can. We've seen that throughout the month of March, that $100 oil, maybe even slightly above that, is not going to really impair the U.S. economy. Now, Asian economies, Australia and Philippines to be more specific, they're going to be under enormous pressure because they get more oil from the Middle East than we do. But I think we're probably going to have to see much higher prices in order to pull back if this is going to be protracted. And we should find out in the next week or two if this is going to be a lot more protracted than Wall Street is basically assuming.
At this point, is the increase in oil prices that you are preparing for stagflationary, inflationary, or deflationary?
I think it's more inflationary than anything else. I think the key when people talk about interest rates is nominal GDP, real growth plus inflation. If inflation goes up by more than real growth is falling, and right now there's very little signs real growth is falling at all, then nominal GDP goes up, interest rates should go up, and the Fed should be leaning towards hiking rates. And that's what we've seen on and off over the last couple of weeks. If real growth falls more than inflation goes up and nominal growth falls, then you can talk about lower rates. But right now, I think what we're really looking at is more inflation than we're going to see a decline in the real economy. We're going to get that tomorrow, with the estimates being 0.9 on March CPI. That's a huge number. It's going to push year over year well over 3%. And we're not going to really be seeing any kind of commensurate pullback in the real economy. So that means higher nominal growth, and that means all things equal, probably drifting higher interest rates.
So at what point do you see, Jim, 10-year yields reflecting that? I mean, this is something that people have been watching. And so far, the increase that we've seen in yields since the beginning of the conflict has really come from real yields. It has not come from inflation expectations. How much could you see that change over the next couple of weeks?
Oh, I think it could change substantially over the next couple of weeks if there's a belief that this is going to be much longer lasted. You're right that even though we were under 4% yields when the conflict started, and we're still at around 4.28, 4.30 right now, so rates have gone up. It's not been because of an expectation of more inflation, because we got back to this Everybody thinks this is going to last between days and weeks and a month at the top, and it's going to go away because they've been burned every other time they thought that something was a little bit more permanent. But if this one turns out to be a little bit more permanent, I'm not talking about the war being permanent. I'm talking about the risk premium and the threat that the Gulf faces, the threat to shipping, the threat to oil production. That lasts even if the shooting starts, and we're going to have higher premiums in all of these markets. Then I do think you're going to see inflation expectations kick in interest rates, and they're going to move higher.
Jim, what's your best case? Do you think that rate hikes are going to be back on the table in the next couple of Fed meetings?
There's a reasonable chance they will, and I don't think we should be afraid of rate hikes. That just means that nominal growth is strong. And there's nothing wrong with nominal growth being strong, even if it is a little bit more skewed for inflation. We've done a very good job of changing the narrative that, up is bad and down is good with interest rates, no matter what, under any circumstance. And that's not always true. If you have a strong economy, higher rates are not necessarily a bad thing. And I think we got to stop with this phobia about that if interest rates go up, everything falls apart. They may be going up because things are getting better.
Jim Bianco of Bianco Research, thank you so much for being with us. I love that. We have to stop with the phobia of higher rates because ultimately it might be a good thing.
Do you think that he was talking to one person in particular with that comment?
It could be a lot of people. It could be a lot of people. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Iranian leadership casting doubts on the status of the ceasefire. The country's president posting on X that Israeli strikes in Lebanon are a flagrant violation of the terms of the deal and will render negotiations meaningless. The comments coming ahead of planned peace talks in Pakistan this weekend. FBI Director Kash Patel saying a former employee of the U.S. military has been arrested for leaking classified information to the media. The arrest coming just 2 days after President Trump threatened criminal charges for journalists who published details of a military operation to rescue 2 U.S. airmen in Iran. And Amazon CEO Andy Jassy issuing his annual shareholder letter this morning. Jassy highlighting the yearly revenue run rates for its chips business now exceeding $20 billion. The Amazon CEO saying, quote, having our own hotly demanded AI chip opens up many possibilities, but perhaps none larger than the ability to lower costs for customers. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, the morning calls, plus Tom's Fitzgerald of TD Cowen on the health of the airline sector. That's coming up next. This is Bloomberg Surveillance.
There's still a lot of skepticism that we'll see any of this oil flow anytime in the near future. It's all about the differential between locations rather than just the flat outright price. Regardless of whether the ceasefire takes place, we're in a new normal right now where the fundamentals are constantly shifting underneath our feet.
That was Stephen Schork of the Schork Group, and the fundamentals keep shifting this morning as we get competing headlines in markets. The way that a lot of traders are dealing with this is just taking off a little bit of that bullish sentiment that we saw rip-roaring back into the market yesterday, down about 0.25% for the S&P. The key point here really is Brent, the idea that it's higher again, and that really does dictate whether it's risk on, if it's lower, or risk off, if it's higher. Today, up 3.4% for the Brent June contract, $97.96. A real question here. We've heard from the Iranians so far this morning. They are putting Lebanon squarely in the ceasefire deal at the same time that Israel overnight targeted a number of different sites in that country.
Yeah, and I think it's going to be a real stumbling block as we head towards these talks on Saturday. And potentially, does it become such a problem for the Iranians that maybe the talks don't happen? We're not there yet, but that obviously could be a risk as we go into this weekend. You have the president and the Speaker of the Parliament both coming out around the same time saying we are not going to abandon the Lebanese. And if this doesn't stop, then it renders the ceasefire meaningless.
Yeah, meanwhile, we are about 13 minutes now away from the core PCE data as well as jobless claims. A real question here about how much we start to see the increase in inflation and a real adjustment by individuals heading into this when it comes to spending. This is really going to determine a lot of what the Fed's response is, and frankly, the administration. Kevin Hassett, the chief economic advisor, speaking just moments ago in the U.S. media, talking about how they still expect pretty strong growth in the United States and an end to this conflict.
Yeah, really high growth. What, 4 or 5%? Very different from what we're hearing from a lot of individuals. Also interesting, he's talking about the fact that pretty confident he thinks Kevin Warsh is going to start by May 15th. Maybe he knows something we don't know in terms of Senator Tom Tillis and where he continuously stands on that debate.
Yeah, the discussion, the rhetoric saying that the deal is still happening, is still on. As we do see whipsaw in oil prices, we're seeing whipsaw in the shares of airlines. Delta's strong first quarter, along with hopes of a U.S.-Iran ceasefire, fueling optimism for the airline industry. Tom Fitzgerald of TD Cowen raising his price target to $84, writing, Delta is moving quickly to reduce second quarter capacity and offset higher fuel via pricing. We view Delta as the most defensive of the big six U.S. airlines. Tom joins us now for more. Tom, thank you so much for being here. What did you make of yesterday's Delta earnings?
I thought they were pretty encouraging. You know, so far they talked about capacity being dependent on fuel and its impact on the economy and air travel demand. And I think that's going to be true for the equities. And as long as they're able to demonstrate revenue recapture and that demand is powering through this, I think the stock can work.
How much is this really an issue of how much some of the big three, or particularly Delta and United, have focused on the premium customer, the price-sensitive customer that will keep spending, that will keep flying?
That's a great question. Yeah, and we think the jury's still out on how the rest of the industry will do, and the loyalty, the higher income consumer, corporate demand, geographic diversity. That's all part of the story here.
There's also a question of how they arrange their flight patterns, given the fact that we have seen disruption in the Middle East. How much do you expect any ongoing changes? Delta, I believe, had a route to the Middle East, a direct route that they were expecting to roll out later this year. Have we heard any intel about what the conflict is doing to shake up some of those plans?
Yeah, I think that's up in the air right now, and they pushed that off. But then conversely, you've had a lot of passengers that usually, from Southeast Asia or Australia who would usually connect to Europe via the Gulf, and some of those are now connecting via the United States. So that's a benefit for Delta and United as well.
Lisa's been talking about this for weeks, if not months, and the Wall Street Journal leading with it today. Delta's ace in the hole is, of course, its own refinery. Tom, how much is that helping this company right now?
It is. It's a unique benefit. It's about $300 million in the second quarter, and it will be driven by refining margins from there. But yeah, I mean, it was helpful in 2022, and it's proven to be a part of the durability story here.
So do you think when it comes to having their own refinery, as it compared to other airlines, are they going to have to pay less for jet fuel?
It's an offset. It was about a 6-cent offset in the first quarter, and that the second quarter benefit translates out to about maybe 25 cents. So it's meaningful. It doesn't bail them out. It's not a game changer, but it is meaningful.
Meanwhile, when you take a step back, what have we learned so far, not just from Delta, which reported earnings, but we've heard a number of commentaries from other airlines as well. A couple weeks earlier at a JP Morgan conference in Washington, D.C., demand still very strong heading into this period, despite the issues with TSA, despite higher prices. What do you make of where that's coming from? Is it disproportionately the premium? Is it disproportionately coming from business travelers?
I think it's all of it. I think all of those folks, whether they're traveling for work or traveling in their personal life, I think it's consumers that are still flush with cash. I think, sentiment might be weak, and there's a lot of horrible headlines on the news every day, but travel demand is proven to be so resilient this whole decade, and I think that's a huge part of it.
There also has been a sense that the biggest are the best suited to manage through crisis after crisis. We saw that during the pandemic. And then we have questions around mergers, considering the fact that some of the merger attempts that have happened in the past have not gone through antitrust. How much do you expect those to be revisited, given that the biggest survive and thrive and the smaller players are really struggling?
It's certainly on the table. I mean, there's been so many rumors that Delta hinted at it yesterday or talked about just the context, because everyone can see the writing on the wall and everyone can see the setup. It's anyone's guess when it actually happens. But just given all the, economics 101 and what's happening in the industry, you would think that the weaker players would start to consolidate.
Is that also because there's a different regulatory environment in Washington now?
Oh, absolutely. I think there's push-pull factors.
So who could be ripe for potential consolidation right now?
Well, ironically, we were out on the road with JetBlue when the Semaphore article came out, and we wrote about that the other week. So, I mean, unsubstantiated, but they've been kind of top of mind of the larger airlines, one who could be in play.
Tom Fitzgerald of TD Cowen, thank you so much for being with us this morning. Looking ahead to the kickoff of earnings next week, although we should say the kickoff of earnings is actually this week, considering the fact that Delta really does sort of sound the clarion alarm or potentially the optimistic tone for the rest of earnings season.
Yeah, absolutely optimistic. And you talked about this for months, how Delta has their own refinery. So when everyone's freaking out about jet fuel, and they should be, jet fuel prices are sky high right now, but they have their own refinery. Wall Street Journal this morning saying that this is Delta's ace in the hole for these surging fuel costs.
Yeah, giving them about hundreds of millions of dollars in offset to potentially these increasing costs. Those increase of costs going directly into how much prices have increased. The latest PCE data and jobless claims set to cross in just a few moments. Bloomberg's Michael McKee joins us now with what to watch. Mike, a key question, how much of the data is going to reflect the post-war period of higher oil prices?
Unfortunately, not very much, Lisa. Really, only the jobless claims numbers are going to be relevant from a time period point of view. We get a third look at the fourth quarter GDP, which isn't going to change very much and not tell us anything about where we are now. And then the PCE numbers, important to the Fed, but this is February data. And the war started on March 1st. So we're really looking ahead to tomorrow, to the CPI report, which should reflect a lot of the war, as gasoline prices are going to help push this up to the highest since 2022.
There is a feeling, though, Mike, and Bob Michael of J.P. Morgan was reflecting this, that so far, heading into the war, it seems like economic momentum was actually better than most people expected. And it sort of points to the idea that people can absorb price increases and, frankly, absorb some sort of cannibalization of their spending power. Is that your sense as well?
It is essentially the case that the Fed and others are following at this point, the idea that we were a little bit stronger. But remember, fourth quarter GDP was revised down to just 0.7, and that's not expected to change. And then right now, the Atlanta Fed's GDP Now number for the first quarter is 1.3%. So we're looking at an economy that has done okay but slowed. It's the one part that is working well, the consumer, that everybody's got their eye on. If consumers start to cut back because of higher gas prices, then you've got much more of a problem.
Michael McKee, thank you so much. As always, for that insight, we are just minutes away from core PCE as well as personal spending and income. What we're expecting is for the core PCE index to come in at 3% year over year. Remember, this is the key target that the Fed looks at. They're expecting a 2%, or they want to get down to 2% coming into this period, already far above that, which is part of the issue that people have about, to Bob Michael's point, is 2% just a myth?
Well, it has been, right? Because they've been cutting rates for the past few years when inflation has been well above 2%. Everyone's been talking about 3%, the new 2%. But Michael said actually he thinks it's more like 2.5%. Maybe for a dynamic economy where the United States is now, maybe 2.5% actually is more acceptable.
The strength in the economy, part of the reason you've seen strength in the equity markets, resilience today, just a touch of risk off, but otherwise people hanging in there looking for some sort of sense of when the ceasefire can actually be called that. Coming up, a fresh round of inflation and jobs data set to cross. Joining us next, Nela Richardson of ADP. Just seconds until the key economic data, the beginning of the 1-2 punch with core PCE coming and jobless claims before we get CPI tomorrow. The way that it's stacking up in markets, a bit of a risk-off tone with real questions about the durability of the ceasefire, down about 0.25% for the S&P, down 0.6% for the Russell. Bonds pretty quiet this morning. We are going to get an auction of 30-year notes later today. A bit of a bid, a little bit of a softening in some of the concerns around inflation. Right now, we are on the precipice of getting that data with questions around oil prices still rising on the expectation that there is some concern over the ceasefire. The latest data crossing just now. Michael McKee, what do you got?
Well, it's important data for the Fed, but it is backward-looking February data in terms of spending, incomes, and prices. The PCE price index for February comes in up 0.4, which is as expected, but that's a rise from the prior month. 0.3 doesn't change the year-over-year number, 2.8%. Core PCE up 0.4 as forecast, same as last month. So we actually see the core PCE year-over-year number fall to 3% from 3.1% as base effects affect that. The jobless claims numbers that everybody's keeping an eye on, 219,000, a big jump up from 203,000 the week before, but not one that would tell you that the economy is really slowing down and companies are starting to let people go. Continuing claims, 1,794,000 fall from 1,832,000. As far as personal income, it fell 0.1%. We're going to have to check the data on that and see which categories fell. Personal spending, though, a little bit stronger than last month, less than expected, comes in up 0.5% on the month. It was 0.4 last month. The economists had thought we might get a 0.6 gain. And then finally, GDP actually significantly weaker than it was in the first and second readings. This is for the fourth quarter, just 0.5% as personal consumption falls to 1.9% from 2%. We were talking before the break, guys, about the consumer hanging in there and the economy strong going into the war. It may not be the really accurate story. Let me dive into some of this, and I'll be back with you in a minute.
Thank you so much, Mike. Yeah, a lot of question marks hanging over this, in particular, personal income dropping 0.1% versus the expected 0.3%. And that question about GDP growth, a real key question mark as well, especially given the retail sales data that also portrayed a less optimistic backdrop. What you're seeing in markets is a pretty muted response, and not really that significant. S&P futures inflecting just a touch lower on the heels of this. You are seeing a little bit of a bid into bonds, but really this is not exactly a market-moving event. And really, the takeaway to me is, what can we glean from data that truly is ancient history? AMH, that feels like, to me, the takeaway increasingly.
Because everyone's focused on the geopolitics right now. And what does this mean for potentially higher oil prices for longer, which is why this backward data doesn't really matter right now. The one thing I think that is interesting is initial jobless claims ticking higher, because that is this real-time data right now. When you talk about and look at the Fed minutes, that you see individuals talk about this dual risk. Maybe when you see PCE in line at the moment, you start to get a little bit more concerned about what's going on in the job market.
219,000 might not get it done, but still, I get your point. How much you're going to get a real-time indicator from these initial jobless claims. Joining us now, I'm so pleased to say, Nela Richardson of ADP. Nela, great to see you. Thank you for being here.
Great to be here. Thank you.
So when you take a look at numbers like this, just before we get into what you're seeing out there, how instructive are they, given how dated some of this information really is?
It's hard to pull a current signal from the data that we've seen, but I think it's meaningful that fourth quarter GDP growth was lower than we thought. And this is before the ramp up in oil prices. So I'm curious to see what the consumer spending numbers look like, how much of a drag spending was. Maybe it wasn't a drag. We'll see. Mike will come back with the news on that. But if consumers were already vulnerable and fragile in the fourth quarter, then that makes the recent spike in oil prices even more relevant in terms of whether the consumer is going to hang in there through the duration.
What are you seeing on the ground when it comes to the hiring backdrop? And we're seeing a slight tick up in initial jobless claims, mixed messaging about it might not be a huge firing moment, but it's very difficult to get a job. Are you seeing improvement or deterioration?
We're actually seeing the fourth week of strength. So when we came out during the jobs week, looking at that reference week that includes the 12th of the month, we put the private sector job gains at 62,000. Since that week, we've actually seen a ramp up in hiring. We're looking at an average of about 26,000 jobs per week in addition. So the labor market hiring seems to be strengthening, which is good news, at least for now, going into what could be a very uncertain period in the geopolitics.
Is there a disconnect, though, to how people feel? Because I know you recently just did a corporate survey asking people, how safe do you feel in your job? And only 1 in 4 said they were safe.
That's right. That's globally. We asked people, is your job safe from elimination? And most people said, no, it's not. And that was the global number. In the U.S., it was 28%. And what's interesting about this report is younger workers and older workers were the most likely to say that their jobs are not safe.
Why?
Because the vulnerability, you have the new college grads entering into a labor market that is very different than what they were prepared for. And there's a mismatch in expectations. And then you have the older workers who are looking at, everything that's going on, whether it's AI adoption or that kind of uncertainty in geopolitics. And they're saying, what's my future in the last 10 years of my career? So there's uncertainty in the middle. That's where there's more confidence. But there's a barbell of confidence by demographics.
There's also a barbell between sentiment surveys where people are expressing anxiety and then people on Wall Street who express bullishness and the optimism, not just on markets, but that person is going to keep spending money. I mean, how do you identify this disconnect? Does it matter if people feel insecure in their job, given the fact that the jobs market isn't terrible? It's not great, but it's not so bad.
Ground truth matters. The workers are at the heart of what's going on in their occupations, in their own firms. So they have a sense of perspective. They know when there's a hiring pause. They know when there's an acceleration. They know what their colleagues and their network are seeing in terms of jobs. So that ground truth, that is incorporated into their sentiment, along with these other macro features that everybody else is watching. So I take it seriously, but I hold it against that hard data showing improvement in hiring. And I think how you mesh these two worlds is that the hiring is so fragmented. It's so concentrated in healthcare. So if you're in a different industry, you are not seeing what the national numbers are seeing because this is a very fragmented hiring schematic we're in.
The national numbers just came out. Personal income declined by 0.1%. Personal spending increased by 0.5%. Core PCE bang in line with that 3% year-over-year increase. Initial jobless claims came in just a touch higher. Michael McKee, you've been parsing through the data to answer some questions. What have you learned?
Well, let's look at personal income first. It's not a pretty picture, even though it's not a terrible one. Wages and salaries increased only by 0.2% during the month of February. In January, they were up by 0.5%. That can be a volatile thing. And of course, January is when a lot of people get raises. But it does suggest people had a little bit less disposable income to spend, as disposable income falls 0.1%. The savings rate also falls to 4% from 4.5%. So what consumer spending we did get, a lot of it probably came out of the savings accounts of people. And then when we look at the GDP numbers, I know that we're interested in why this happened. Of course, consumer spending was down on the month by down from the third quarter. It was rose only 1.9%. Business spending is the big reason that we saw lower GDP numbers, though. Fixed investment up just 1.5%. Non-residential fixed just 2.4%. And that's the category that represents what businesses are doing. So overall, not a pretty picture here in terms of where the economy was, at least where we thought it was, and where these numbers are telling us it actually was when we went into the war on March 1st.
Mike, thanks so much. That's really helpful, and it gives us some insight into what exactly we're looking at. That's Michael McKee, our Bloomberg economics correspondent. A key question here, Nela, with respect to business investment during times of uncertainty. Given the fact that it was tariffs, now there's the uncertainty over the price of oil, over the geopolitical conflict. How much do you expect companies to pull back on hiring plans that otherwise would have been implemented based on the ongoing uncertainty?
I think you're going to see a stop and start in terms of hiring. I think that is reflected in the volatility we've even seen in the first 3 months of the year. When there is a clear path, when there is a certain future, I think you'll see especially small firms move ahead. And in fact, that's where we're seeing a lot of the juice in the ADP report. It's from small firms. And those small firms may not be able to wait for the right moment to hire. Their revenue is based on how many people they have actually working. Large firms have more discretion. So again, I think you'll see this bifurcation by establishment size, by industry. Some industries like healthcare are not all that vulnerable to what's going on because the demographics are pushing the hiring, not the market, infrastructure that's pushing the hiring in some other industries.
Well, what if the conflict is more protracted, though? You just wait? How long can you wait for?
You can't wait for forever. That's right. Businesses need to go on. They need to serve their clients. They don't want to lose clients as they're waiting in indecision, and they don't want to lose the momentum in whatever investments they're making. And we know that companies have been making a lot of investments in AI. You don't want to sit on those. You have to move forward with those. And so there is this wait and see approach. There's probably going to be more sporadic hiring. In my mind, the bottom line is more volatility in the hiring that we're seeing, that every month is a live month that's going to be harder to predict.
I know we have this fresh data dissecting, even though it's backwards looking. Is the most important data basically just tanker trackers and seeing how many ships are moving every single day through the Strait, or lack thereof?
I think that will give us some certainty in terms of maybe oil prices or the movements of goods and services. But I would suggest that the hiring market is very different. It is concentrated, and I've said this before, in services and in healthcare, and not immune to the macro picture, but driven by different triggers in terms of where the jobs are coming online. And so what's going on in the Middle East is not necessarily affecting the demand for home health care aides in Iowa. And that's where we're seeing actually the surge in growth, not necessarily in Iowa, but in this older demographics wanting to age in place. And that is really reshaping the labor market in real time right now.
Yeah, unfortunately, people are getting older and sicker, and so someone's got to take care of them. Nela Richardson of ADP is going to be sticking with us through the rest of the hour. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. Recapping that data we just got, the Fed's preferred inflation gauge, core PCE, coming in line with estimates for February, notably before the impacts of the war hit the economy. Personal income falling below expectations at just 0.1%, with personal spending also missing. And in the labor market, initial jobless claims ticking up last week to 219,000. And speaking of job cuts, Disney is planning to eliminate as many as 1,000 positions in the coming weeks. The Wall Street Journal reporting many of the cuts will be in the company's recently consolidated marketing department. Disney has laid off more than 8,000 people since 2022 as part of a major restructuring. And in sports, the Masters is underway at Augusta National in Georgia, with the first round teeing off in just the last hour, quite early. It's the first time since 1994 that both Tiger Woods and Phil Mickelson will miss the tournament. Rory McIlroy is vying for his second straight green jacket, and world number one Scottie Scheffler will be hoping to take home his third. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. And if you're wondering why John is not here this week, maybe put two and two together.
As Yahira was speaking, I was like, oh, this makes perfect sense. This is why Ferro's out this week.
Clearly. Anyway, I hope you're enjoying the tee off. Up next, Michelle Weaver of Morgan Stanley saying the market continues to look very healthy. Plus, Danny Berger with your morning movers. Meta and CoreWeave rising after striking a new AI deal. The deals keep getting done despite concerns about geopolitics. This is Bloomberg Surveillance.
We can live with oil $100 a barrel for a while. I think what the administration has done a good job of doing to us over the last year plus is to train us. And we look for signs of when is the rhetoric at a high, but they're starting to look for an exit. And we're starting to see that now. And I think that's why the markets are so optimistic.
That was Bob Michael of JP Morgan Asset Management with a tone of optimism despite some of the negativity that you're seeing in the price action. Futures lower after yesterday having a pretty significant rally, the biggest of the month, on the heels of a ceasefire agreement. Real questions today about how long the ceasefire can remain in place, down 0.3% for S&P futures. A bit of a bid into bonds, although ultimately going nowhere, 3.78% after getting core PCE that was bang in line with where we had expected it to be. The dollar softening just a touch, and Brent crude higher by 4%, $98.68. Less than an hour away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa, some big tech movers this morning over a deal. CoreWeave and Meta. Meta investing $21 billion into CoreWeave on top of an already $14 billion. It's about AI data data center capability, expanding that out. This deal will run from 2027 through to 2032. Meta's already investing in its own, but it needs more capacity than just what itself can do, hence this partnership with CoreWeave. Also, a little bit of sell-side action to go through this morning. Bernstein upgrading SanDisk to a street high of $1,250. In fact, they say that the blue sky scenario could be $3,000. You can see it's trading at 810 right now, but it is up 3 3/4%. They're just pointing to the high cost of memory and a market that keeps underestimating just how robust their earnings cycle is going to be. We also had another upgrade to a tech company, Marvell, another chip company. This upgrade comes from Barclays, from neutral to overweight. They say that this should be treated as an optical company, and there's a huge amount of growth, 90%, that they could see from here, even as some of the market share gets given to Broadcom. Those shares up 4.3% in the pre-market. Lisa.
Thank you so much, Danny. Counting down to the opening bell. Here's a trading diary for the rest of the week and into the next. Friday, we get tomorrow, CPI and University of Michigan sentiment survey. Ultimately, we all feel like this week has been a year, and this year has been a decade.
Almost there.
Of course. On Saturday, we get the U.S. and Iran holding peace talks in Pakistan. Monday, bank earnings kicking off with Goldman Sachs. Tuesday, results from J.P. Morgan, Wells Fargo, and Citi, plus PPI. All of that giving a read on exactly how the economy is maneuvering through this. And turning back to our top story, stocks falling with optimism over the ceasefire fading. Michelle Weaver of Morgan Stanley writing, putting aside recent geopolitically driven price action, the market continues to look very healthy on a fundamental basis. Michelle joins us now for more. Michelle, you are not alone, and good morning.
Good morning.
A lot of people are saying as long as this remedies itself on some level or creates some new stability, it's time to go all in a real way. Is that your sense as well?
I think the fundamentals absolutely have to remain your North Star. And while we've been whipped around at the price action, whether it was from AI disruption or the war in Iran, the fundamentals have still remained very healthy. We're at 12% year-over-year growth going into the first quarter. We've seen earnings revisions move higher throughout the year, despite those concerns I just mentioned. So on a fundamental basis, we are still in a very good place.
How much is a year-over-year increase in earnings per share? Kind of on the tailwinds of a dollar that has been kind of weakening earlier this year and giving a really good comp for a lot of these companies, and perhaps, I don't want to say artificially inflated, but something that isn't sustainable for the remainder of the year.
That's one benefit, but I think you have to look at where we are in the cycle. So if we zoom out, we were in an earnings recession up until the middle of last year. The average company in the Russell 3000 was seeing negative year-over-year earnings growth. That changed in the middle of last year. We are now in an environment where earnings is positive and accelerating higher. So even, with some of those moves that you just cited, I don't think that that's the underlying story. It's a broad recovery in earnings.
The way you talk, it sounds like the market, and you think it should basically just look through what's happening in terms of the geopolitical sphere. But at some point, does it become more systemic and you have to rethink some of these corporate earnings?
I wouldn't say we're just looking through it. We've seen a lot of damage already happening. So partially what I'm saying is we've already de-risked. We're in a good fundamental place, but we've also de-risked. The multiple on the S&P is down around 18% from the highs last fall. If we look at what's been going on in the Russell 3000, more than half of members are down more than 20% from their 52-week highs. So we've seen a lot of that de-risking already happening, combined with a good earnings picture.
Have you seen the same with the consumer?
So the consumer is in a pretty precarious place right now. We're seeing, things on the positive side, things on the negative side. Of course, gasoline is weighing heavily on consumer household budgets. We did see higher than typical tax refunds this year. We're seeing spending still hold up, but people are absolutely nervous and they're very sensitive to anything impacting their budgets.
Nela, you've been talking with a lot of companies, large companies, about what their confidence level is, what their conviction, what their hiring plans look like. Do you see the same optimism from them that Michelle is talking about that we're seeing in earnings expectations and earnings more broadly?
I see a little frustration, actually. These are companies that want to grow, and they're a little flummoxed right now for two reasons. One, it's the macro uncertainty that's putting not necessarily their own operations, but their customer operations on hold. But also, it's the change in sentiment when it comes to the workers. So, clear example, I talked to a manufacturer who couldn't find workers early career to do 12-hour shifts. It's a difference in what the worker expectations around jobs, being in the office, being out of the office, what kind of salary growth. We've been spoiled by the post-pandemic competition for workers, and they're not getting the same terms for these new jobs. So I think there's a it's a mixed bag. They see growth, they see opportunity, but they're flummoxed by the macro headwinds and the change in the worker sentiment.
Michele, how much do you see that in terms of which areas in the equity markets are set to outperform, sort of really coming from the industrial sectors, the materials, some of the commodity-linked spaces, much more so than over the past, say, 2 decades?
Yeah, so right now we're recommending barbelling on the cyclical side, industrials and financials, along with high-quality growers, the hyperscalers. You have a really rare opportunity right now. The hyperscalers are trading at less than the 5th percentile on valuation since 2023. It's a very good way to get high-quality exposure to the AI trade at a good value right now.
You do have an interesting point in your note, though, about data center construction, similar to what Dan Greenhaus was saying, the political pushback on this.
Yes.
How challenging is that going to be for the hyperscalers?
It is a big challenge right now. We're seeing that be one of the primary constraints for data center construction. And I think part of this is going back to the conversation on the consumer. People are very price sensitive, and there's this perception that data center construction is pushing power bills higher. It's a nuanced issue, and it really depends on if you're living in a state with regulated or unregulated utilities, but this is still a big issue for voters. It's becoming a big issue for politicians, and it's something I would watch into the midterms as a big risk.
Michele Weaver of Morgan Stanley, thank you so much for being with us as we await new headlines to direct the day ahead. Nela Richardson of ADP, what are you looking for tomorrow heading into CPI? That might give us a better real-time look of exactly how higher prices are trickling into consumer bills.
Well, obviously, I'm looking at oil prices and energy prices, and I want to know whether that's going to feed through goods. I want to look at food prices, both in-home food prices and food away prices, because that's going to hit. When you think about this K-shaped economy, you can't avoid food and energy and the impact on the consumer budget. Now, usually economists look through those things. We dismiss them. We look at core. But I think all of the action is in the headline, because that's where you're going to see the spikes in energy and whether that's going to flow through to the other parts of the index.
Yeah, in the meantime, we're also looking to all of the headlines and whether we do get some sort of resolution, the latest raising real questions about what the ceasefire actually looks like.
I think a lot of people are questioning the credibility, clarity of the ceasefire, but also Iran really doubling down today that Lebanon needs to be included in the ceasefire. And I think that's a huge stumbling block ahead of these Islamabad talks on Saturday.
Yeah, a lot of pieces coming together. Nela Richardson of ADP, thank you so much for being with us this morning and for the second part of our show. Coming up tomorrow, we've got Michael Purvis of Tallbeck and Capital, Krishna Guha of Evercore ISI, Bob McNally of Rapidan Energy, and Abby Yoder of JP Morgan Private Bank, with the risk on yesterday turning just a little sour this morning as people question the validity of this ceasefire. Equity futures just off a touch, with energy prices surging by more than 3%. This was Bloomberg Surveillance. Good morning.